2 years into the pandemic, wealth managers are finally getting back on track. But Russia's invasion of Ukraine is upending the fragile recovery, sending shockwaves through markets. Inflation is at an all-time high, and commodities are in turmoil.
We have seen JP Morgan calling even $185 a barrel oil by the end of the year.
Amid the volatility, some investors are turning to crypto for quick gains. For others, it's a digital casino.
I would say that cryptocurrencies are a bubble.
Against this backdrop, how can investors navigate the turbulence? What does the future of wealth look like? We convene leading investors, economists, and money managers to provide actionable intelligence. This is the Bloomberg Wealth Summit. Please welcome to the stage Sonali Basak, financial correspondent, Bloomberg Television.
Hi everyone, welcome to the Bloomberg Wealth Summit. And whether you're visiting us virtually from around the world or here in New York, welcome. At this year's edition of Bloomberg Wealth, we're going to examine how geopolitical risks and the changing global economy are making investors rethink how they search for yield. We have some fantastic speakers from a variety of different fields from around the world who will share their unique insights on global wealth. Before we get started, we have a few announcements, and that includes acknowledging our founding sponsor, BNYMellonWealth Management, and our presenting sponsors, Grayscale and LinkedIn Sales Solutions. For our virtual attendees, if you experience any issues with audio or video quality, we want you to refresh your browser or use the chat box in the bottom right corner of your screen for support. And for today's event, we've also partnered with Thiston, an audio-to-text platform that is transcribing today's discussion in real time. That'll still make it easier to make the event more accessible. You can go back, you can listen to what people have said, and we want to also hear from you. Please engage with us on social media using the hashtag BloombergWealth and on Twitter, Bloomberg Live. Let's get started. Please join me in welcoming our first speaker. That is Meena Lakdawala-Flynn. She is the co-head of private wealth management at Goldman Sachs. So Meena, you're a really great person to start our discussion with because you have had 20-some years in experience in private wealth. Goldman Sachs is also known to manage money for some of the world's most wealthy individuals. So maybe we start by anchoring the discussion on who your clients really are and what they're looking for.
Sure. So Goldman Sachs has been around for more than 150 years, and we have been in private wealth management since the 1950s. We're very focused on helping our individual clients reach their wealth objectives so that they can maximize the impact possible with their wealth. The way that our clients experience the firm is through our advisors. Our advisors have been with the firm on average a very long time, and this allows them to get really deep with their clients and really understand their values, their objectives, and really customize their risk tolerances and portfolios in a way that they can make it through various life events, various life market cycles, and really optimize for that. The other thing that we do at Goldman is we really surround our advisors with areas that are unique for ultra high net worth clients. And these tend to be areas like optimizing your asset allocation, how to deal with concentrated single stock, tax planning. And our advisors really curate the firm and this sort of content to be able to deliver that to our clients.
Meena, when you talk about wealth, what does it really mean? How much wealth does a typical Goldman Sachs private wealth client have?
Sure. So one of the things that David Solomon and John Waldron did about a year and a half ago is they reorganized Goldman Sachs. And one of the things they did is they created a consumer and wealth management business. And so what we do within CWM is that we work with all levels of wealth across the organization. And we really help people optimize their wealth based on the investment offerings that are relevant for them to be able to do that. And so any level of wealth, we would love the opportunity to be able to work with clients. Within private wealth management, we work with ultra high net worth individuals, and these individuals do have opportunities to invest in offerings that are more institutional in nature, and those tend to be more illiquidity illiquid, which tend to be more on the alternative side.
Well, we're going to talk about alternatives in a second, a hot topic kind of in this inflationary environment. But when we think about the risks that are mounting in the world, there's a war in Ukraine, there's inflationary pressures. What are your clients most worried about?
You know, I would say our clients, they're very focused on two things, if you think about their objectives: wealth preservation and wealth growth, capital growth. What prevents that from happening? Permanent loss prevents that from happening. How do you get permanent loss? Taxes, inflation, concentrated single stocks that go poorly, leverage and being a forced seller at the wrong time, so not having the right asset allocation, and nationalization of assets. We have a global private wealth management business, and so based on the region that you're in, that means a lot of different things based on that region, and we're working with our clients to help them.
Well, let's break some of those things down a little bit. Let's start with inflation. How are clients pivoting their portfolios in relation to inflation, especially because you have said so many are hoarding cash?
Yep. So let's just talk, what do we think about inflation right now? In the US, we do think that inflation's peaking right about now. And we expect that it's probably going to go down to a little less than 4% by the end of the year. And that's because you're getting supply chains that we expect to moderate. You are going to get rate increases, which are really well televised yesterday, and you'll get the runoff of the Fed's balance sheet. The other thing that's also sometimes overlooked is really the fiscal stimulus that we had last year. That's not going to be the same this year. So that combination of things is why we think that inflation probably ends up around 3.9% by the end of the year, and even lower next year. What do you do to protect against high inflationary environments? Asset classes that tend to perform well: equities, alternative assets, real estate. And so within equities, we're recommending that our clients have exposure to names that have pricing power, that have high margins, that have strong profitability. You think about what's really gone on in the marketplace over the last year, and you've seen, or really the last 6 months, you've seen the names where previously were really valued highly on future growth potential being really the stars. Now what clients are very focused on is profitability. So the underlying profitability. What sectors do we think that comes in? Healthcare, energy, and disruptive tech that's profitable. If you look on the credit side, what we would recommend is focusing in on private credit opportunities where you have floating rate exposure. So that floating rate will reset as you get increase in interest rates. And then lastly, on the alternative side, there's a number of things, but real estate, you'll get rent resets as inflation goes up.
So there's two conflicting things here. One, a focus on value, if we're going to use market parlance, value versus growth, this worry about growth, but also somehow a focus on disruptive technology. So how then do your clients, because they have the opportunity to invest in venture, do they feel about venture capital?
Sure. So taking a step back on alternative investments, ultra high net worth individuals, as I mentioned before, have the opportunity to invest in alternatives. And we very much think that is an asset class to embrace for them. And we've been doing that since the 90s. And I say that because we worked with our clients through multiple market cycles during that time period. And the thing that's proven to be successful and profitable for them is staying the course with vintaging. So coming up with a plan of how much money you want to put to work every year and continue to put that money to work, because it's impossible to time the markets, and it's also impossible to, to figure out what underlying strategy is going to outperform at any given time. And so we've seen no decrease in our clients' commitments to alternatives, and nor are we recommending one. If you look under the hood as it relates to alternatives and what we see people doing right now, whether that's family offices that are investing directly or whether that's our managers, there is a discrepancy between private market valuations and public market valuations. Public market valuations are at a discount to private market valuations. What does that mean? You have crossover managers that are right now spending more of their time investing in public markets. And given that you had a relatively quiet IPO and follow-on market, we're probably going to see more pipes in the public markets where managers will be able to take advantage of. On the private side, what we're seeing is that because you've not seen equilibrium be reached between where companies want to raise capital and where investors want to invest, they're doing non-equity setting deals. So raising capital in a way that does not cause them to reset their equity valuations. Things like fixed discount converts, so very focused on structure. We do think that this equilibrium is going to be met over the next couple of quarters, but whether it's venture, whether it's buyout, it is very much about staying the course because you have to focus on the top managers. You cannot invest indiscriminately. And what we look for when we look for managers is who has a sourcing edge, who has sector expertise, and who has real operating experience. And it's right now, whether it's a venture capital firm or whether it's a late stage company, where that operating expertise is really going to come into play, because you have to be able to work with the cash that you have to be able to continue to transform your company.
By the way, this is going to be a huge theme throughout the entire day, but I also want to take a big step back here and look globally.
Sure.
So some news about Goldman Sachs. They were the first bank to announce an exit from Russia. They also were among the first to say that they would be moving staff from Russia to Dubai. You manage a global business. So when you look at what's happening around the world, in Russia, in the Middle East, in China, how is that making you think about how you address the global client in this era of geopolitical uncertainties?
Sure. So yeah, very proud of our organization that we were the first to retreat from Russia and bring our people out of Russia to the extent that they wanted to, and we are winding down our business operations in Russia. We do have the good fortune of running a global business, and as I mentioned before, the concerns that people have in each one of those regions are different. It could be sanctions, it could be nationalizations of assets, it could be concerns of common prosperity. And you've seen that in all of the regions that you just mentioned. And the thing that we really focus on is having a diversified portfolio. And that doesn't just mean investing in your own country. You really have to diversify outside of your country when you're in those locations.
So you mentioned common prosperity. When you look at China, is common prosperity going to be a net positive or a negative for Goldman Sachs?
I think common prosperity will increase wealth levels across the spectrum. And when you increase wealth levels across the spectrum, what you get is you should get more spending, especially from the bottom, those that are with the least amount of wealth. And that increased spending will spur GDP. Increase in GDP is good for Goldman Sachs.
So there's things to be learned from what is happening in China over here in the US. You have common prosperity in China, but back in the US you have President Biden's tax plan. When you were talking to your clients, what are they most concerned about in terms of how that might impact their wealth and the investments they might make moving forward because of it?
Sure. Last year, we definitely saw a lot more activity in terms of estate planning being set up, which actually didn't come into fruition. This year, right now, we are not seeing as much concerns or actions around Biden's recent budget proposal. What that proposal did suggest is that there's going to be more focus on deficit reduction than on fiscal stimulus, and that's given where inflation levels are, and that they really want to accomplish a few policy goals, such as renewable energy, and they may increase taxes to pay for that. And so where might that come from? It could come from the corporate side and or the individual side. And so if it's on the individual side, it could be a surtax, it could be including private businesses and the net investment income tax. So there's a number of ways, and regardless of what it is, we're going to help our clients think, really strategically about how to invest.
One thing you had mentioned to me previously was that it's not just about corporations being taxed, it's about the executives as well. How far do you think that goes? And do you think that this can really reach a wide set of corporate America and people who are at different levels of management here?
Sure. So I think what you're referencing is in Biden's budget proposal, there was a recommendation of a 1% tax on buybacks. And buybacks have been the most significant net buyer, corporate buybacks have been the most significant buyer of equity markets over the last several years, and we actually expect that to be $1 trillion this year. And so to the extent that there is anything that happens on the corporate tax side for buybacks, we do anticipate that's probably going to lead to more volatility in the equity markets. The other thing alongside that 1% tax that was suggested is elongating the time period by which corporate executives would be able to sell their stakes. And so if you're doing a buyback, they don't want you to sell your stake at the same time. The thing is that we don't know how broad that goes, right? Corporate executives, you can go very deep into an organization. And the thing is, what's really good for these executives is being able to diversify their wealth. It's one of the things that I said could create permanent loss is, having concentrated wealth. But to offset the concern that, is out there as it relates to, potential timing of the market, I really think the SEC is being thoughtful as it relates to increasing transparency around it. So increasing transparency around the 10b5-1 plans that corporate executives have set up as it relates to when they're selling, the price they're selling, the number of shares, et cetera. So my sense is that there's going to be more focus on that side of it.
I want to shift to another topic here because a lot of us have probably spent a lot of time in Florida lately, where a lot of people from New York have been moving. There's been a lot of business conferences, and you held one recently. But there's been a lot of talk about the disparity in corporate America of women rising to the top. You see it very, very differently from where you sit. Can you explain kind of the demographic you're seeing, the rise in women in wealth, and how that might be fueling your business?
Sure. So maybe just to put some statistics to that in terms of the demographic shifts. There's three things that are going on. The baby boomers are aging and passing. What tends to happen is that first transition goes from the male spouse to the female spouse. And that's because women outlive men by 5 years and tend to marry 2 years older. The second thing is there's a number of women who are making financial decisions and managing their money for the households has increased about 30% over the last 5 years. And then you also have more women coming into money. So those are the demographics that is unfolding, and it's not lost on the wealth management industry. We started seeing that firsthand in our business in terms of the number of female clients that we've had the opportunity to work with. And so we created a platform internally in the firm, and we just recently launched it, called In the Lead. And it's geared towards our private wealth management female clients as it relates to content, advice, and community. And just to bring that to the next level, this summit that you suggested that we brought 100 leading women at heights of various aspects of their fields: philanthropists, corporate executives, family founders, those who represent the next generation of their wealth, together. And we covered topics that were very timely, things like cybersecurity, NFTs, investing, the geopolitical landscape, and that was very interesting. But the thing that was electrifying was actually getting this group of women together and having them feed off of each other in terms of ideas and experiences. And some of the themes that came out of that, for example, that I found very interesting, but again, not surprising because we're seeing it. These women feel very fortunate, and they want to pay that good fortune forward. And what does that mean? They want to invest and give along common values. That common value that tends to be very significant that they're focused on is equality. So yes, climate change, but also very much equality. The other thing is that they want to prepare the next generation for wealth. And that doesn't just mean from a financial perspective, but that means from living with purpose and having a meaningful life outside of wealth. And then, we did have quite a few corporate executives who are running multi-generational families at the summit with us. And one of the things that really stood out is being known by your first name, not by your last name.
You mentioned equality, and this is a time where over the last couple of years, the stock market has risen, housing prices have risen, and the wealthy have gotten wealthier, but those without wealth have been left behind. How much of that focus on equality is a result of that?
I think people are very attuned. Our clients, all of our clients, are very attuned to the wealth inequality globally. And that is why we are seeing so much more focus on not just giving to areas that will help that inequality, but also investing in areas that will help with that inequality. And by the way, that does not mean expecting subpar returns. You're probably going to get better returns by following some of these investing strategies.
So another thing that you had mentioned was that these women were interested in NFTs. I think crypto is something that's on a lot of people's minds. In fact, when we polled our audience on which asset class will perform best this year, 44% of our audience said it would be cryptos, even more than commodities, which, as we know, are flying through the roof. And so I'm wondering, what are your clients saying?
Sure. Cryptocurrencies and NFTs have been very much part of our discussion with our clients for the last several years. And we very much believe in the digital asset ecosystem and the growth of the digital asset ecosystem. Where we are focusing our clients is really on the underlying infrastructure. So the picks and shovels that's really going to help the technology and the backbone of that digital asset ecosystem. From an NFT perspective, there's a lot of clients that want to understand. They want to understand, like, what are they, but also how do you have value? How do you derive value? So, for example, at the summit that you you just mentioned, we had a session on NFTs and physical art versus digital art, and it was a very spirited conversation. But I say a little bit of the bottom line was that investors or clients are looking at NFTs from an investment perspective versus from an aesthetic perspective. And when you look at NFTs from an investment perspective, how do you value them? And if you want to think about art from that perspective, it's very hard to know which companies or which tokens are going to be the blue chips. And so if you don't know who's going to be the blue chips, it's best to be prudent, but in terms of sizing of it, but also to look at things like community followership and what type of access do these tokens give you that would increase their value.
So do your clients feel as low on equities as our poll suggests?
So I would say we at Goldman, and I think it's pretty much shared by our client base, we don't think that there's going to be a recession this year. We do think that the probability of a recession has increased in 2023. Equities, if you look at 2019 to 2021, the S&P was up 100%. We think that equities are going to be relatively flat from here. So we're actually at 4,700 on the S&P, so up marginally. And that's pretty consistent with what you saw in terms of what others are expecting. So we wouldn't confuse moderate upside, and even if you've got a muted environment, with a bear market. And there's real tax consequences from selling equities where you're sitting on a real big gain. And so you have to, for us, it's really, how do you think about being thoughtful about offsetting gains and losses as well as just overall structuring? But then also, how do you put incremental capital to work and focusing on equities that are probably going to, more value versus growth?
So we only have about a minute left here. Mina, in the next year, and I should say you took this role right in the heat of a global pandemic, right as it started. What is your goal for the next year?
Our goal is to help our clients maximize their investment portfolios and make it as easy as possible to enjoy their wealth and have the most impact as possible with their wealth.
Mina, thank you so much for your time. We're so looking forward to the rest of the summit with you. Thank you again, and thank you for listening.
Please welcome to the stage CEO, President, and co-founder of Ares Management Corporation, Michael Arougheti, with Bloomberg's Jason Kelly.
Morning, everyone. Good morning. All right, so these are real people.
It's exciting. It's really exciting.
They're not avatars. We're not in the metaverse. In fact, you were telling me an interesting story about getting together for the first time with a bunch of your colleagues just recently.
We've doubled our headcount in the last 18 months. I was just overseas at a strategic planning session, and half of the people had been onboarded but had never actually met their colleagues in person. It was quite remarkable.
Yeah.
So,
well,
good energy.
It's a fascinating time. I'm really happy to be here with you. We've got a lot to talk about, and fair warning, We're going to talk a lot about sports in a few minutes because this is an area not just for fans. We were talking backstage about how much is going on from a fandom perspective right now, but from an investment perspective too. Such an interesting time. Before we get to that, you alluded to something that I think is a really nice way to set the table. The acceleration of your business over the last 18 to 24 months has been remarkable. Give us a state of play for Ares right now, sort of the lay of the land.
Sure. Yeah, it's been a transformational couple of years, but really a transformational decade for our company and alts generally. So it was interesting hearing the prior panel was talking about the attractiveness of alts, and I was all giddy until I saw the audience poll, and it was a little bit of a letdown. But Ares today is a large global alternative asset manager. We have about $315 billion of AUM, 2,100 employees in 35 offices throughout the globe, North America, Europe, Middle East, Asia. Of that 315, close to 200 billion of it is broadly invested in the private credit markets.
Right.
About 55, 60 billion of it is invested in the real asset space, real estate and infrastructure. About 30 billion of it is broadly invested in the private equity markets. And we have a growing business in secondaries and Asia distressed for the remainder. So really do have a global view. It's an interesting perch, particularly in markets like this, to see equity and debt markets operating together across the globe.
Right. Well, let's talk about that global reach. I want to pull up a Twitter poll here because I think you're going to have an interesting answer versus maybe what the Twitterverse said, or a more nuanced answer, as tends to be when you're talking about Twitter. So which country or region will offer the best returns over the next 5 years? US, Europe, China, emerging markets. I have a feeling your answer is going to vary depending on which of your colleagues you might have been talking to last.
Yeah, well, I form my own opinions, right? It's not the last person that I talked to, but
oh wow! I didn't mean it as a burn,
no,
but that's interesting that you took it that way.
I'm kidding, I did. Yeah, it's interesting. It speaks volumes, I think, to the strength and fallibility of Twitter. Sometimes, as that seems like a simple question, but for someone like me in my seat, are we talking about public equity markets or private equity markets? Are we talking about credit or equity? Are we talking about, so when I look at that, I would say generally I would agree that the US markets writ large across what we do will generally outperform. I think particularly given where the world is today, just capturing the next 12 to 24 months of exposure to the US markets versus China as an example will help you outperform. But when I look around the globe at the things that we can invest in, one of the highest risk-adjusted returns I see now is, for example, investing distressed in Asia Pacific and China specifically. So there will be spots within those geographies that I think will stand out, but I would agree that I think the US, for a whole host of reasons, is going to be the best backdrop.
And has geopolitics made its way made a meaningful impact yet, especially war in Ukraine, on sort of what you're seeing in terms of performance?
No, the challenge with this environment is, and one of the benefits of being in the private markets is we get real-time information from our portfolios. So the joy of being in the alternative asset space is we have perfect inside information because we are controlling companies and partnering with management. Everything that we've seen to date has been unbelievably strong. And so telling everybody what they know, the economy is on very sound fundamental footing, and now it's really the question of the look forward. Even in Europe, having just come back and spent time with our teams there, the effects of the conflict in the Ukraine have not found their way into the portfolios. Now, we don't have a lot of direct exposure, so we would be talking about second and third derivative type consequences, so it will take some time. You do begin to see it happen more quickly in places like just who's allocating.
Yeah.
Right. So if you have large sovereigns who benefit from rising energy prices, you may see them more actively allocating as oil prices rise. So there are a lot of influences, but generally speaking, those markets just aren't really developed enough for the type of alternative investing that we do. So, thankfully, we just don't have a lot of direct direct exposure.
So speaking of alternatives and speaking of something that might influence those tweeters, is exposure to private markets. In a way, you and I were talking backstage about the fact that exposure to private equity and private capital has been like the holy grail for retail investors for a long time. High net worth has sort of made its way in, especially in a more meaningful way over the past few years. Just yesterday, you guys, I believe, keep me honest here, announced a new fund really aimed at getting folks from a retail perspective into the private equity markets, the private markets. Tell me how that works and what that represents.
Yeah, so there's a fair amount to unpack there, and maybe just broadly, and it segues a little bit from what was talked about on the prior panel. If you look across the entire available investment universe and you just say generally traditional versus alts, or publics versus privates, and really start just delineating, what you see is that the alternative asset space generally is growing at a 2 times rate to the traditional markets. So roughly 10% per year compound annual growth rate. People expect that to continue for a decade plus versus 4 or 5. Mm-hmm. What's not in those numbers, but it helps support the growth, is structurally, alternative assets don't have to be in the market. So one of the challenges of investing in liquid markets is the fund structures themselves force you to take a view on a market through investing, whereas in the private markets, you can express a view by not investing.
Right.
You also can time your exits. So you can manage volatility much easier. And the fund structures don't have outflows. So when you go through volatile markets, you're not having to defend your existing positions and reallocate your book as aggressively. So there's a lot structurally that just sets alts up to grow continuously. So as a result of that, what has happened over time is we're generating pretty significant excess return relative to what I would call the public market equivalent. So private equity will generate consistently through cycles higher rate of return than public equity. Private credit will generally generate excess return relative to syndicated loans and high yield bonds and so on and so forth. So not surprisingly, putting aside what we all expect will happen over the next 12 to 24 months, we've been a 3-decade-long secular deceleration in interest rates. So every investor on the planet, whether you're an insurance company, pension fund, or a retiree who happens to be living longer, you need excess return and yield quite desperately in some cases. And so that's fueling this demand. It's really a hunger for that yield and that excess return in this interest rate backdrop. But now that people have experienced that excess return, we are seeing that demand be persistent. What you're hinting at is there's a new secular shift happening that's a combination of folks like Ares packaging alternatives for the retail consumer, and the large wealth platforms now rewiring the way that they're selling these products to access retail demand for alternatives.
Right.
And that is a little bit of a holy grail, not necessarily for us, because that capital is available to us, but for the retail investor. Yeah. Because if you think about historically 10 years ago when we were selling product to retail, it was high net worth and ultra high net worth, and they were effectively tagging along with our institutional clients. Over the last 5 years, we now have credit product, we have real estate product, and now private equity product that mass affluent and true retail investors can access with partial liquidity, which is a real revolution in terms of their ability to consume what used to just be the purview of the institutional investor in the high net worth.
Right. It's so interesting to think about the menu that's available both to retail investors. And so let's shift the conversation a little bit, because you and I know each other pretty well. We're both big sports fans. In fact, we're marveling the idea Masters is teeing off today with Tiger Woods. NBA playoffs, very much on the mind of your colleague Tony Ressler and the Atlanta Hawks. We just came off of March Madness. We've got opening day today for baseball, a little belatedly, but we got there. We're all good. It's all fine. This is now investable in a way that, if we were talking even 5-10 years ago, was just not on the table. I mean, I look at what you guys have done, F1, Major League Baseball, European soccer, and more, and soccer here in the European football, American soccer. I'm trying to mind my P's and
hard.
Q's here. How do you do that? And how does that come about that becomes something that is interesting to you?
So we obviously have personal investments in sports that inform our view on long-term value creation. And through that lens, what we know is if you look at value creation in just owning sports franchises, for the last 20 years, they've all outperformed the S&P by varying margins, but pretty significant. So if you look at compound annual growth rate in the value of sports franchises, it's been 15% and largely non-correlated to other asset classes that you can invest in. So putting aside personal tax attribution, all the fun that you have, it's just a really interesting exposure, but it's never really been thought of as an alternative asset class that's accessible to many people. COVID changed that, and I think we were fortunate enough to see that trend emerging and innovate a little bit. And the reason that COVID changed it is prior to the pandemic, the opportunity to invest in sports was largely the bastion of ultra high net worth individuals and banks.
Yeah.
And at least in the US, the leagues were fairly protective of the sanctity of that capital structure, rightfully so. But when you start seeing a world where you don't have fans and seats, games are canceled, there's no merchandise sales, contracts around your sponsorship are challenged, you begin to realize that there is a need over a longer period of time for flexible capital solutions to be available to these teams, leagues, owners, and that in order to preserve this 15% compound annual growth rate, you need to start thinking about alternative forms of capital because the amount of capital in that high net worth and bank channel is not enough, frankly, to support that kind of compounding for the foreseeable future. So when COVID hit, a lot of very high quality franchises were seeing a need for capital just to bridge liquidity or to invest in growth and really try to, punch through that in a different way. And so we leaned in that and accelerated our strategy to bring our institutional capital solutions into the sports arena. And it's been very well received, to your point. We've been fortunate enough to invest all up and down the sports ecosystem. And when you really peel it back, it's about content. And so when we think about sports, it's sports media and entertainment, and it's the entire ecosystem of sports, whether that's venues and stadium finance, media rights securitizations, merch, consumables, sports betting, in-game ad tech. So when you really get into this world and you say, what's driving these values? It's content, and now with the advent of streaming, the highest value content is live, unscripted, and in sports, it's live, unscripted, and parsable. Right. So it's probably one of the most consumable forms of content. So it's super exciting.
And global too. I mean, I think about the idea that just by dint of circumstance, we're looking at some of the biggest trades that we've seen about to happen. One in the U.S. with the Broncos, one in England with Chelsea. As you think about those valuations, I have to think those skyrocketing valuations have something to do with the opportunity here, right? And how do they?
They're both super exciting assets.
Yeah.
Both benefit from scarcity value. So harking back to even the prior conversation on the prior panel, there is a scarcity value, store of value play when you're talking about elite franchises like Chelsea. But to your point, it's the globalization, and we see this in our existing investments, is China is one of the largest growth markets for the NBA. And so just being able to see that and understand what the development of that fan base means for the value of your brand and your content is a totally different world than we used to live in. And so I think you have to detach from, and it's hard for a lot of private market folks who are focused on cash flow, but you have a significant amount of very high quality assets with varying levels of cash flow that continue to increase in value because of the global brand.
And the business, I think what's also interesting, you and I have talked about this, is that the business models are different from country to country, from league to league in terms of what you can do. You've seen more flexibility come in on, say, the NBA, where Dial is offering a product. I do wonder if the NFL and the EPL, start to do that, just because these are.
You have to imagine, and again, I don't have any knowledge to say one way or the other on the NFL, but if you just look at the value of the franchises and you look at who owns them, and we didn't talk about our retail private equity fund that we talked about is largely anchored by a secondary strategy.
Right.
And if you think about who owns franchises, there's obviously control owners, but there's also a whole universe of smaller minority LPs that are the beneficiaries of all this value creation in illiquid assets.
Right.
So you talk about the Dials of the world. There's also an opportunity to just think about, a monetization event for those smaller LPs over time, which is effectively a sports secondary.
Yeah.
And so the embedded universe of folks who own these assets but don't really have a path to liquidity is just by definition going to have to create a need for institutional capital to clean that up.
So what sport are you most excited about? Not as a fan. I know what you like, but
in terms of value creation.
In terms of value creation.
It's interesting. I'm going to give you two answers.
Okay.
Because if you think about the major U.S. leagues, they probably give the highest total return. Mm-hmm. They're the best run, most viewed, best media rights, globally recognizable. So dollar for dollar, you probably want to be there. But when you go across the world, the other regions offer you, much healthier profit models, just based on the way that those teams are structured. So I think it really depends on how you think about investing in this space. If you're looking for compounding total return, you'd probably gravitate towards trophy leagues, trophy assets. If you're really coming at it from a structured credit, structured debt perspective, you're probably going to gravitate to the cash flowing areas like European football and things like that.
And so, as we start to wrap up the conversation, put this in the context of sort of the broader investment outlook, because one of the fun things about sports I've found is that you do sort of see cultural touchstones, economic touchstones, to your point, sort of growth versus value in some ways. So as you synthesize all of that, what's the general mood inside your shop broadly about the world?
Cautious, but probably not as negative as the public markets are feeling. And I think part of that is if you really peel back and look at what's taken the public equity markets to the current levels, and what's going to obviously have us give some of that back is it's been led by a handful of very large tech names with high growth rates, and we're changing the discount rate. So by definition, we're going to have to see values correct. We're all going to be dealing with that in our equity portfolios to some extent, but we're not going into this current cycle with that amount of overshooting on value and discount rate. So I think the private equity markets are going to have an easier time digesting. The reason we feel so good in our shop is, like I said, 200 billion of our 300 billion is private credit.
Right.
And that's all floating rate secured debt. And so, from a positioning standpoint, as rates go up, our portfolios actually generate higher rates of return. And as you asked about the last couple of years, we've been fortunate that part of our transformation has been an acceleration in our fundraising. And so, we're coming into this market with a significant amount of uninvested capital available to us to navigate the markets. But I go back to what we're seeing in our portfolios, and we've never really seen this type of cycle where we have demand side pressure, supply side pressure, and a geopolitical overlay. So we all have to learn as we go here. But some of the demand has to be temporary. in the sense that we're still digesting a significant amount of government stimulus and a transformation of the labor market. And some of the supply chain challenges we're seeing have to be temporary as well, just given COVID issues in the APAC region and some labor issues that we're having here. So, I'm cautiously optimistic that we're going to be able to navigate this. Obviously, the Fed has a pretty significant job ahead of them. But when you look at what we're seeing in the portfolios, there's just a lot of buffer that's been created in terms of balance sheet health, cash flow growth, et cetera, I think gives us a little bit of time here to try to get this right.
Grateful for your time.
Always
Thank you
great to
for
see you.
sharing some insights and get back to work.
Yeah, well, I got to go watch the Masters.
Yes, absolutely.
Thanks,
Thank
guys.
you, guys.
55% of investors say they understand how taxes and costs can impact the growth of their portfolio. Do you? Try our Active Wealth Accelerator and find out how managing costs from taxes can help you create long-term wealth.
Please welcome to the stage Sinovation Ventures Chairman and CEO Kai-Fu Lee with Bloomberg's Carolyn Hyde.
Thank you. How wonderful to see a packed audience. How wonderful to be reacquainted with Kai-Fu Lee once again. It was a few years ago in New York City that we first met and dined, and I understood about the vast wealth of information that we can then impart on a wealth summit. And I mean, you need no introduction because, of course, you are, for many, of course, a key investor. You bridge the flow of information and help us understand really what's happening from a deep tech level over in China. But you are a visionary in many ways. Of course, you're a man who has been deeply within the world of artificial intelligence for about 3 decades, working for some of the key big companies, the research and development. You're also, of course, a key author, and many will know your books. But I am interested in, first and foremost, you're a man, when you look at your Twitter handle, says that you live in Beijing. And I want to understand, as a man who's traveling, and as we try to understand how, at the moment, China is dealing with the next COVID wave. You, of course, wrote, I think, in the summer of 2021, how China had but a blip within COVID, and artificial intelligence helped them exit in many ways. Is AI, is technology helping the current shutdown, the worry that we have about the economy in China as it tries to look at a zero COVID policy?
Well, there are a number of roles AI is playing in China. One is being a main part of new drug discovery and vaccine discovery. And another part is robo-buses and robo-vans are actually operating, some of it in Shanghai right now, in helping to deliver. But of course, to be honest, they're making a very small impact in light of a city being locked down. So I wish we could do more, but that's the limit of what we can do right now.
How are your entrepreneurs? How are the businesses that you help thrive there? How do they cope with the current scenario?
Well, it's really limited to Shanghai. The entrepreneurial spirit is alive and well. But as we all know, there is a sector rotation happening in China, right? The internet platforms and apps are being more heavily regulated, and that perhaps puts a ceiling on how fast their growth rates can be domestically. Long term, they could potentially go international, but obviously entrepreneurs and investors, if there are any in the audience, are probably being cautious about that sector. But don't think of that as the entire sector, because in the US, when you say tech, you mostly mean Google, Facebook, and Microsoft and the like. But actually in China, the fastest growing and most exciting sectors are the new deep tech sectors. That internet companies are, platforms, e-commerce, social, games, and all that. But really where the VC money, the attention, the high valuations are going are in artificial intelligence, semiconductor, synthetic biology, drug discovery. And that's what we spend most of our time on. And the entrepreneurs in that space are incredibly excited and passionate.
Passionate, excited, thinking differently amid what we perhaps rather basically call some sort of crackdown? Are entrepreneurs seeing the path for them to flourish, to still take a company from where you invest in it all the way through to becoming a public company, becoming a sensation, being worth billions of dollars?
Yeah, I think the market greatly influences people's mood, So when the Chinese government is incredibly positive on deep tech technologies, and we're witnessing companies in semiconductors and in artificial intelligence going public. Now we at Sinovation, we invested in about 50 AI companies, and probably around 10 will go public in the coming 12 to 18 months. So when you think about Chinese tech stock, there will be a rotation of interest and perhaps also of value going from internet company being the core focus to deep tech companies. This is a concept that is not yet taking place, but if you look at the increasing number of AI companies, AI healthcare companies, AI chip companies that are in all stages in China, I think this is something that all around, from individuals to engineers to entrepreneurs to VCs, PEs, and the government are very, very excited about. It doesn't quite get the media coverage as the internet regulation side, but hopefully that will change.
Okay, let's give it some media coverage. Let's, of course, take to social media, Twitter. I want to see you all thinking and galvanizing and taking part in our discussion online as you are in here. We take no worries if you perhaps dive into your phone every now and then and spread the word, because I'm interested in semiconductor. I think I spend about 20% of my life talking about chips at the moment on air and the supply chain concerns within that. What is it at the moment that is investable, is interesting from a VC level in terms of the chip sector, the chip industry?
Yeah. So from a VC level, being a VC in China, this is a sector that the government is heavily promoting and investing and subsidizing. So this is in light of China's self-perceived need to have self-sufficiency in semiconductor in light of the competition with the US. So for us, this is a sector that traditionally we think of as capital intensive and not giving great returns. But two big things have changed. One is that the government support in terms of land and factories is making it more investable because a big part of the capital expenditure is now covered by the government. The second part of interest in this sector is that following what happened to Huawei, many Chinese companies are thinking they better be prepared for a locally sourced semiconductor chip solution. So it's easier to sell domestically. So that's the positive aspect from a VC perspective. So for us, though, we also at the same time see the euphoria in China, so much investment. There's also a bubble in price because of these two reasons. So our strategy is to go early, provide a lot of value, get in when it's cheap, and then once they tape out, the value goes crazy, we go for the ride. But a comment, since most of you are not in VC, but perhaps thinking about the semiconductor as an industry, so I think one big shift going forward is the potential decoupling. I sure hope that doesn't happen. I hope it gets better. But even if there are no further policy changes, I think China is feeling it has to develop self-sufficiency just to be on the defensive and prepared. So that decoupling will create challenges for many companies. They'll lose sales, but they'll also create opportunities for ones that can straddle and take advantage of the decouple. So that's one aspect.
Can you just paint the picture of what decoupling, if it lives up to the fears, looks like, where the lines come?
Actually, I don't worry about the worst case because any extreme measure in decoupling will result in a very severe lose-lose. So I don't think it'll come from that. It'll more come from maybe a few companies will be added to Huawei, and then that will hurt a few companies. And maybe China will say, well, we better build this chip, and that will create a change in dynamics. But the most interesting thing I want to share, especially for people in the audience, because that's, VC is my business, you're thinking about semiconductor, is that the workload that is driving the future of semiconductor, I think is, there are a number of big workloads. One is obviously automotive, right? A transitional change to deal with electrification and autonomous driving. So new chips will be needed there. But another one that's even more fundamental is artificial intelligence. If you look at how fast AI applications have required semiconductor usage, right? The cycles that it uses. It used to grow with the Moore's law, 1.5x over the previous year, up until about 10 years ago. Since then, it's grown at 7x. And
Give us applications of where chips are being so necessary in the world of AI?
Right, so all the most exciting things you read in the newspaper, AlphaGo, AlphaFold, AlphaFold 2, Lambda, GPT-3, all of them are running on these $50, $100 million computers because smaller ones won't do. Because the last 10 years, if you think about 7x per year for 7 years, right? We began with just one GPU card. Now you need massively parallel numbers of them. And that workload being driven from AI, and I think it's to a certain extent from crypto also, I think can create a new life in the semiconductor industry.
Crypto, are you looking? Is that an area in any way?
Not in China. No.
Good point. But the applications thereof, talk to us a little bit about, when we think about supply chain, when we think about more of a decoupled landscape, we worry about the security with getting what you need to make chips, getting what you need to make, the energy transition in and of itself in many ways. Is that something that you're looking at investment opportunities? Is that something the entrepreneurs at the moment are thinking about or even solving for?
Yeah, I'm particularly excited about the new energy transition. That is finally an area US-China can see eye to eye with the Biden administration here, and then China has always been very strong at that. From our angle, in addition to carbon neutral and all those positive things to society, another important realization is that if we look at a 5 to 10 year horizon, energy will shift from a natural resource industry into a manufacturing industry, right? The leaders of new energy will not be countries that have natural resources like natural gas or oil, which is clearly still the case today. But in 5 to 10 years, it will be the speed at which solar plus battery storage will become the standard, the cheapest way. And the companies and countries that can manufacture and develop solar panels and batteries using whatever technology needed, electrochemical, lithium going to sodium and hydrogen, and using AI for the design. Those are things that I think are extremely well suited for China to invest. So that's one of our key thrusts, is that at a global level, there may be an opportunity to shift power from the countries that have natural resources to China, which has not that many natural energy resources, but is the best in manufacturing. China, in fact, is already the leading battery and solar manufacturer. And this is not just having factories and doing it cheaply. A company in China called CATL, I wish we could invest in them, but they're fantastic. They're the world's leading battery company. And they're building great technologies, next generation, a lot of research. It's a very low profile company, and it's very deep tech, very much fits what the government would support. And one example of what they're building is a cell to chassis technology that will turn the chassis of a car into the battery. And that will reduce the parts by 40%, the weight by 30%. That car will be able to go 1,000 kilometers per charge. And that may become a licensing platform that can turn a battery company into a powerhouse in the automotive industry.
How much are they thinking about how dirty it is to actually access lithium, for example, and how much innovation is happening at that level?
Yeah, that's certainly a part of the research. And I think people want to go into cleaner and cleaner energy. So a lot of explorations into hydrogen and others are happening. Those are still research, so I can't really predict when the transition will take place. Yeah.
You've of course been traveling a lot in the Middle East. Is this a conversation that you're having a lot there at the moment? And about there must be a sort of an anxiety as to access to such metals and gases and the likes that are needed for the next generation of clean energy.
Yes, I think that's an area of discussion. I think the countries in the Middle East are actually, you would think they're facing challenges based on what I described, but they're actually very forward-thinking. I think they've progressed a great deal. UAE and also to some extent Saudi Arabia are thinking about these new energies and the transition and how they will do it. And then the near-term oil prices is giving them a paying dividend so that they have the much even bigger wallet to invest. So I think in the future, Middle East will still continue to play a key role in energy, even as we shift away from fossil fuel.
And when there is, you said it's going to become, a resource issue to a manufacturing issue. How is China's manufacturing prowess at this exact moment? How are you seeing it evolve, take on the moment where, arguably what COVID has done has made us all think that much more about robotics than we ever did about human. Has that helped them weather this current storm?
Absolutely. What began as using robots for social distancing and reducing the transmission of COVID now has turned into a huge adoption of robotics and AI in the Chinese factories. And other than technology advances, it's important to think about for China how important this is, because China is the world's factory. China's economic foundation is based on manufacturing and industrial applications. And countries like Vietnam are paying people half as much as China, and therefore potentially taking away manufacturing. So China's only solution and answer is automation. So there is no other choice. So there are massive programs to support factories from adopting automation and AI. And automation and AI developing technologies for manufacturing is one of the hottest areas of investment. We invested in a company that within 4 years grew to about $135 million in revenue. That's an AI company, not a manufacturing company, and is now listed at multi-billion-dollar valuation. So I think the amount of requests and the growth of the business is just phenomenal. So I think if COVID had kind of left its marks on US, China in AI, I think China has taken the advantage of this opportunity to jump ahead and use AI in manufacturing in which it is strong. US is using AI brilliantly in the enterprise software. And we see all these great enterprise software companies that are building data on which AI can do great things. So actually people talk about US-China competition. I think they kind of found their own course.
Okay, so found their own areas to compete. I'm interested in how you're wheeling out and finding these unique smaller startups which are arguably, I'm sure they're never cheap, but cheaper. Where do you find them out? How do you ensure that you're the first person that's managing to access that sort of information?
Yeah, we at Sinovation are very, very unique. We are really nerds and technologists. We have 15 PhDs in my VC. So we love technology, we try technology, we understand technology, we speak their language, and we look for where technology and business intersect, right? So, for example, the company I talked about called AI Innovation, which built AI for manufacturing, we basically saw technology year after year becoming ready to be used, and we saw China's need for economy and policy and manufacturing, and we said someone should create a company that does AI for manufacturing. So we went out and found the dream team, and it's that we have the dream team that's able to develop this in record time. And we were able to get in this company at something like a $10 million valuation. It's unthinkable now. Now it's worth well over $1 billion, over 100x return. And we're continuing to do that in other sectors, right? We're looking for scientists who have very unique technologies in synthetic biology.
Let's talk about that, because you are looking a lot about the AI application within biopharma in particular.
Yes.
What are the areas that you think are most ripe for disruption there?
Yeah, I think AI and healthcare is a phenomenal combination, because so much data is being gathered in healthcare. And when you have huge amount of data, AI can create tremendous value. And we know that today with genetic sequencing, multi-omics, pathology, radiology going digital, and wearable computing, so much data is flooding the doctor or the patient that we can't possibly comprehend. Only AI can do that. So we're very big on using that. But one challenge is that the AI people and the biomedical people don't necessarily get along. They each see things in their own lens. What we try to do is find areas in which their interest is aligned. For example, people working on synthetic biology, on protein structures and protein-protein interaction, and the AI as a tool to help predict that structure and interaction is a perfect marriage. And then together, they're creating drugs, pharmas, that can treat diseases that weren't before treatable. So that aligns their interests. And we just help create the two companies. I think very similar to what flagship pioneering does in the United States, putting together the right multidisciplinary talent to build great things. As contrasted with, what about building AI that can replace a doctor? That doesn't bode well because doctors aren't going to cooperate, and you have to fit in the hospital ecosystem, and also all the issues with AI misdiagnosis, and so we don't want to get into that one.
When you described how the pharma community relate to the technology community, it reminded me of sort of how the US and China are currently being thought of, and trying to find a marriage, trying to find where it works together. Do you think long-term we will find that? I worry when such strides are being made in the area of treating disease, that if we do have some sort of decoupling, well, we won't share that information. We won't share that access to great learning and to improvement in life in general.
Yeah, I'm somewhat optimistic that when a new drug is invented, that will be cross-border. New treatment will be cross-border. New scientific discovery will be cross-border.
What gives you that optimism?
Because this is not IP, this is saving lives. On the other hand, I think sharing IP will be tough, and user-patient data sharing will be tough. So we just have to pick the right ones to find the collaboration.
Has COVID in some way helped or hindered that collaboration?
Well, in the early stages, I don't think the collaboration took place. But I think more recently, we're seeing signs of hope. The new drug from Pfizer is being heavily tested in China, and may be an important part to China's ability to overcome the current second Omicron strain.
Leave us with us, if you will. The optimism that you bring is one that I think many of us desperately want to be hearing right now. How is it that you see foreign capital that might be sat here, still able to access the companies that you're currently funding at a lower level? How do you think that the sharing of information and the sharing of wealth might be able to continue between the two countries you straddle?
Actually, the China capital market is completely open to US investors. We are raising a fund, we're taking US dollars. We have no issue investing into pretty much any Chinese company. Even if they ultimately go public in China or Hong Kong or US, we will be able to get the money out. There are a small number of entrepreneurs who prefers local currency, and there are a small number of sectors that don't accept foreign investment, but deep tech isn't actually one of them. So if you're an optimist, this is a great time to put the capital in China, because deep tech is an area China's committed to making work. And even if you're not so optimistic, now is a window of opportunity where you can do that. If you view the window may be closed in the future, well, better get in now.
And will that window of opportunity to list in the US still be there, do you think?
I think there's a decent chance that once the SEC clarifies what the requirements are, I think the Chinese government would like many companies to be listed. Maybe there will be requirements, not all companies can list. So I hope that can be worked out. But even if that continues to struggle, 90% of Chinese companies are now listed in mainland China or in Hong Kong. So the US dependency is not as large as it used to be.
Kai-Fu Lee, you are a technologist at heart. You are clearly a very successful investor. You're an author, you're a visionary, and we thank you for sharing some of that story with us today. Please do give it up for Dr. Kai-Fu Lee.
Thank you.
Please welcome to the stage former Chairman, CFTC, and former Assistant Secretary of the Treasury, Timothy Massad, Chief Legal Officer at Grayscale, Craig Salm, and partner at WilmerHale, Tiffany J. Smith, with Bloomberg's Allison Verspril.
All right, well, thank you all for joining me today. I think we have a really great conversation ahead of us. As a reminder, Grayscale is a sponsor of this event. And so we're going to go ahead and kick today's conversation off with a Twitter poll that we conducted prior to this meeting. And basically what we asked was which U.S. regulator should provide federal oversight of cryptocurrency. And the results were, SEC 37.6%, CFTC 22.7%, and both with the most at 39.7%. So to kick it off, I'd like to get our panelists' reaction to that poll. I'll go ahead and start with Tiffany on that. Can you was that a surprise to you?
So yes and no. So traditionally, the CFTC regulates institutional markets. So I could see why the crypto market, which has a lot of retail investors, folks would conclude that the SEC should have jurisdiction. But I think an alternative view that some folks are thinking about is whether or not there should be a new federal regulator. And without expressing views as to whether or not that should be how things work out, I think that if you think about crypto and how it differs from the traditional securities and commodities markets, you have a whole asset which whole purpose is to disintermediate. So traditionally you have regulation of the exchange, the broker that interacts with the customer. There's a clearing firm involved. And both the intermediaries as well as the asset itself differ from traditional commodities and securities. So that could be another potential way that crypto is regulated. On the other hand, because the US compared to other markets already has a lot of regulators, it's not actually ideal to have another regulator into the mix. But I think that there is some merit to recognizing that crypto is different from securities and commodities, and then therefore having a regulatory regime that's more tailored to crypto so that the benefits of the technology and of the asset class can be recognized.
And Craig, maybe you can offer your thoughts as well. And how do what's the industry's thinking on this, and what would be kind of the effect of maybe having the CFTC gain a little bit more authority? We know that there's been some push for that on Capitol Hill. So maybe you can talk a bit about that as well.
Yeah, so I think crypto is no one unitary thing. There's cryptos that are used more like money, cryptos that are used more like commodities, currencies, and so on. And so I don't think that one regulator should necessarily have full jurisdiction over it. It really depends on what is the use case and how should we promote that innovation and also protect consumers or investors from using it. So you have Bitcoin, which is more like a digital gold on one end of the spectrum, but then you have NFTs, which are more entertainment and media. And so should the SEC be regulating that? Should the CFTC be regulating that? Should it be another federal agency? I think those are important questions that we should be thinking about.
Well, and Tim, I wanted to ask you too. So, if the CFTC was able to get some additional powers, I think it could take a while because Congress would need to act. But if they were to get some additional powers, how long do you think it would take them to get up to speed with this new authority? What do you think they would need in terms of resources?
Sure. Well, yeah. Let me first, though, go back to the original question because the smart money was, on both, right? I mean, this is not going to change. We're going to have both regulators. Neither Congress nor the Biden administration is going to try to change this. And, after the global financial crisis, when we were putting together Dodd-Frank, we faced a somewhat similar issue with over-the-counter swaps. And that act is named after Barney Frank, who was the congressman from Massachusetts who has always had a quick wit. And people were saying, well, we should consolidate the SEC and the CFTC. And Barney said, well, you could do that, just not in this country. And his point was, yeah, it may sound very reasonable, but the politics make it impossible. And that's true here. So we're going to have two regulators. But the real issue, as we've noted here, is that even those two regulators together don't have all the authority that we need. And that's what a lot of people don't understand. They think, well, gee, it's either a security or a commodity. The SEC and the CFTC just need to get together and decide, and then we'd have clarity. No, because when we declared Bitcoin a commodity during my tenure, that gave us jurisdiction over futures and swaps using Bitcoin, but it didn't give us jurisdiction plenary jurisdiction over the cash market for Bitcoin. It's a bit like, CFTC has jurisdiction over cattle futures. If you want to buy or sell a cattle future, that's going to be subject to the CFTC. If you want to go buy a cow, they're not going to help you, okay? So that's true with Bitcoin. If the CFTC gets the power to regulate that cash market of a commodity, they need the resources. I've told the chairman, be careful what you wish for, because you better get the resources to do this, because it's going to take time to hire all the people. I mean, there's a lot of really smart people in this industry, a lot of talent going into it, but it is going to take them time to ramp up. But that is what we need. We do need some oversight of this cash market.
Well, and I want to follow that up too. So earlier this week, SEC Chair Gary Gensler made a speech. He talked about the CFTC and the SEC needing to work together to regulate and get exchanges registered that were trading, security tokens and commodity tokens. Can you maybe talk a little bit about what that meant to you and how that type of plan might work? And then
sure. Well, I think that is the challenge, because we do have exchanges that are trading both, things that are securities and then things that aren't securities. And so I was very pleased to see Chair Gensler's speech saying, they were going to work with the CFTC. You could imagine some kind of self-regulatory organization being set up under both agencies, which would come up with standards. And you would have standards that apply to those exchanges and the currencies that they're trading, regardless of their classification. And that could help a lot, because what we don't want, is to kind of have a bifurcation of the market here and of the exchanges. I think that would not be a good path because of this fragmented legal framework we have.
Got it. And Tiffany or Craig,
Yes.
maybe either of you could weigh in with your kind of perception of that speech. And I think it was also interesting that Gensler said he thought basically no exchanges is trading something that he doesn't consider at least one of the tokens to be a security. So.
Yes, so I think it's important to view that speech in the context of a broader initiative, which was this White House executive order from a couple of weeks ago around allowing the digital asset ecosystem to flourish with responsible innovation. And we can get more into that report, but it did ask all the federal agencies to do studies on this industry and figure out how can we, on the one hand, balance promoting innovation while also protecting investors and consumers. And so you see hints of that in that speech. But one thing that really struck me was references to an older time within the cryptocurrency ecosystem. There's references to ICOs and coins being issued without functionality and to raise money. And we no longer are in those days. The digital asset ecosystem has evolved since 2017, and I think it's really important that regulation evolves with it. So I think with these studies, we'll see more of that education happening and figuring out how can we keep up with the innovation to, again, on the one hand, promote it, allow it to flourish, while also still protecting investors and consumers.
Yeah, I agree with that 100%. I mean, I'll just add 2 points. One, I think it's critically important. Those studies are critically important because whatever regulation is adopted for the crypto industry, it has to adopt, it has to think about both where we are today and where we're going. If we have regulation that's tailored to 2017, it's just not going to be efficient and it's not going to allow the market to flourish. And then the second point that I took away from that speech was relevant to the point I made earlier about the current regulatory regime just not really totally neatly applicable and fitting the digital asset ecosystem. It talked about how exchanges, digital asset exchanges, actually serve retail investors, which is different from how exchanges in the securities markets work, and question whether or not we need additional regulation to be able to tailor or address that difference between securities exchanges and digital asset exchanges. And that's another example of how it's not the best solution to just take the already existing security scheme and try to put it over to the digital asset scheme. Instead, we need to think about the differences and adopt sensible regulation that actually can address the risks in the digital asset ecosystem.
Well, if I may add, though, I agree it's good we're not in those ICO days anymore, but the truth is, this industry may be very technologically advanced. It's way behind in terms of standards for investor protection, to prevent illicit activity, and from a standpoint of financial stability risks. I mean, the exchanges, they're simply not subject to the standards that we have for our securities and derivatives exchanges, which ensure integrity of trading, which prevent, or at least designed to prevent manipulation and fraud, which are designed to ensure transparency. We don't have that. You have exchanges that, you know, are taking your order. They're not bound by any rules on how to execute that, but they could have conflicts of interest. They can have their own market-making operations. They can have their own proprietary trading operations. They can have interests in the very tokens that you are buying. And we don't have any rules on that. Now, some exchanges are better than others in terms of their standards, and that's good, but we don't have any rules. And with DeFi platforms, I mean, any of you who are involved in marketing or designing complex investment products, even products that aren't that complex, know what kind of disclosures you have to make. Craig knows what kind of disclosures he's got to make on a lot of the stuff that Grayscale offers. You've got DeFi platforms offering all kinds of things without any of that. So the real question for this industry is how much is it going to embrace the need for regulation? And some people definitely are, which is great to see. And are we going to get that without having some major blow up or crisis that will ultimately bring it on? Regulation will catch up eventually. It's just a question of how long and what has to happen, you know, in order for that to happen.
All right, and to that point, it is important that regulation catches up with the innovation and it's able to evolve alongside with it. And I also think it's important that when we are coming up with new regulation, which I think probably is needed, you know, you have this new technology that was invented a little over 10 years ago, and we're applying laws from 80 plus years ago. So with the internet, for example, you know, new laws and regulations were developed to accommodate that industry, and I think so too should be the same for the cryptocurrency industry. And when we are making those changes, we should consider what are these new benefits we have from crypto. We've removed intermediaries, so that removes a lot of the risk that you have in traditional finance around custody and counterparty risk and things like that. So we should consider these new things when we're also evolving the laws alongside with it.
Well, I would say we have new intermediaries. We didn't remove them, really. I mean, the exchanges are intermediaries. They're just a different category of intermediaries.
Those are the centralized intermediaries within crypto, but within decentralized finance, that is a true removal of the intermediaries. I'm talking about true DeFi, not the decentralized in name only.
So I'm going to interject here and just switch gears here for a second because I want to make sure we get to some of these other areas. But so the SEC has approved a Bitcoin futures exchange traded fund. We've seen multiple applications now for a spot Bitcoin ETF, and all we've seen so far are denials. I wanted to make sure we got to this because I know Grayscale.
It's my favorite topic.
Yeah, let's talk about it. So one, I mean, what do you think it would take for the SEC to approve one of these? What's Grayscale's experience been like so far? How confident are you?
Before I answer that, can I take a quick poll from the audience?
Sure, go for it.
How many of you in this room currently hold Bitcoin? How many of you in this room who do not currently hold Bitcoin would do so if there was a spot Bitcoin ETF? So that's really interesting because on the one hand, it's showing us that people are already getting exposure to Bitcoin, but they're not necessarily doing it in the same protective manner that you can do through a structured, regulated, registered ETF. So I think that's really important to take note of. And then also, if there is an ETF, you will have more access for investors to gain exposure to Bitcoin. So thank you all for participating in that. Yeah, so to answer your question, Grayscale, our flagship product is Grayscale Bitcoin Trust. Launched in 2013, became public in 2015, became the first digital currency SEC reporting company in 2020. And over the years, it has really proven to be the standard for how US investors can access Bitcoin through structured, regulated investment vehicles. Today, it's the largest publicly traded Bitcoin fund in the world, has about 30 billion in AUM, representing about 3.4% of all Bitcoin outstanding. It has over 850,000 investors across all 50 states, and it's trading hundreds of millions of dollars in daily trading volume. And right now, we're looking to make it an ETF. We're looking to make it more robust, more regulated, better track its NAV to really be the optimal way for investors to gain exposure to Bitcoin. And so last October, we filed an application with the SEC seeking to convert it into an ETF. And that kicked off a 240-day review period where the SEC has been inviting in the public to submit comment letters on why they think or don't think that the US should have a spot Bitcoin ETF. And knowing this, we launched a campaign to really activate our investors and the broader Bitcoin and finance community to submit letters in. So right now, there's a website up called grayscale.com/comment that I invite you all to visit if this subject matter is of interest to you, and really explains what the issues are at hand. And since we launched that campaign, there's been over 3,000 letters that have been submitted into the SEC. This is all on their website, and you can go through them. And it's 3 real common themes that we've seen across these letters. One is that there's hundreds of thousands of investors in GBTC today. They want to be further protected by allowing the product to convert into an ETF and just be a better way to track the underlying NAV of the fund. Today, it's currently trading at a discount because it's not an ETF that can engage in arbitrage, and that's representing about $7 billion of trapped capital in the fund. The second theme we're seeing, which we touched on before, is if you want the US to remain competitive within the crypto and Web3 industry across the world, well, one way you can do that is by bringing Bitcoin further into the regulatory perimeter of the US. And one way you can do that is by approving spot Bitcoin ETFs, just making it more accessible for investors. And then the third point, which you mentioned, is we already have Bitcoin futures ETFs. So why do we not have Bitcoin spot ETFs? They're priced based on the same underlying markets. So from a regulatory perspective, they really are the same thing.
Looks like Tim had some thoughts.
No, I mean, I can appreciate Craig's frustration here. If I were him, I would be frustrated too. I think we have Bitcoin ETFs, futures ETFs, that is, because those Bitcoin futures are traded on regulated markets. Those markets are regulated by the CFTC. So I think Gensler and the SEC decided, okay, we'll approve those. But I don't think they're willing to approve a cash ETF until they have confidence in the trading in the cash market. So it comes back to these exchanges that are trading Bitcoin in the cash market, right, when you just buy it for cash, aren't subject to standards. So I think, they want to see those standards develop. Now, shortly after Gensler took office, I wrote a piece saying, well, here's what they should do. They should approve an ETF if it meets certain conditions, and basically have those conditions be the standards that we want to see these cash exchanges follow in terms of preventing fraud and manipulation, in terms of transparency, in terms of reporting, and so forth. So it's kind of a backdoor way to regulate the cash exchanges, even though he didn't have that authority. They haven't taken me up on that offer yet.
Well, so
we'll see.
To that, I would say, if they don't have confidence in the cash markets, then how do you justify approving the futures-based Bitcoin ETF, given that the Bitcoin futures market derives its pricing from those cash markets?
It wasn't done under my tenure. That's all I'll say.
I'm glad
And I guess one last question for Craig on this. So what is Grayscale prepared to do if you do get a denial on this application? What's the next step?
We're putting the full resources of the firm behind this Bitcoin ETF conversion for GBTC. It's our #1 priority. Michael Sonnenschein, our CEO, in a Bloomberg interview, said that all options are on the table, and that's the truth.
All right. Are you willing to elaborate what all options on the table means?
All options are on the table.
Okay. So I want to, Craig had actually mentioned this earlier in the conversation, but I wanted to bring it back to the president's executive order and get all of our panelists' thoughts on that. So I'll start with, Tiffany. Do you feel like this was a significant step? Do you feel like there were any places where the executive order maybe fell short of what you were looking for?
So I think it definitely was a significant step. I think I was hoping and pleasantly surprised that the order talked both about the risks associated with digital assets, but also talked about its benefits, and particularly inclusion in the financial markets and the potential for the U.S. being a leader in innovation. I also was pleased but also frustrated to see the studies that are required as a result of the executive order. The studies are, in one sense, as we were talking about earlier, and before we get to a place where we have regulation that will actually work and effectively both protect investors in the crypto ecosystem as well as allow it to flourish, we need to understand where we are today. And so the studies give the regulators an opportunity to work together and to understand like where we're at. So when we have recommendations for regulations, we can, they can be at a place that actually talks about the market today and also the future of it. Like, as we were talking about earlier, a lot of the regulations we have today focus on intermediaries. And the future of crypto, like with DeFi now and the potential for DeFi and Web3 in the future, is about disintermediation. And so we need to have regulations that have that in account and are not thinking about having a central counterparty that you impose the regulations on. With respect to what potentially fell short in the executive order, you know, I think that there's nothing in particular. The thing that people have been noting is that there was a lack of reference to states. As folks may know, certain states have been forward-leaning and have embraced crypto and kind of are, you know, ways and years beyond the federal government. And so there are states who are saying that they wish they would have had a place for them carved out, and then an executive order that at least recognized where they were and potentially would leverage some of the work that had already been done over the past few years. But that's really it. We'll see what the studies come out and what they say.
Any other thoughts?
Sure. Well, I think they started working on this, I think, as early as last summer. And I think at that time, one of the principal drivers was concern in the White House about what they saw happening with China's rollout of a central bank digital currency and the national security implications of that. The EO was broadened, and I think it's great that it came out. I think it's great that it takes an across-the-government view and covers the whole field of digital assets. But I think the Treasury Department, for example, is very focused on the future of the payment system and the efficiency of the payment system. Secretary Yellen is giving a speech in a few minutes about that. I think they're thinking a lot about stablecoins, how to regulate stablecoins. They're thinking about, you know, do we need a central bank digital currency? I think some folks in the White House are still very focused on some of those national security issues and kind of role of the dollar issues. And while regulation of crypto is covered, I think that will still be left to kind of the regulatory scrum, if you will, between the CFTC and the SEC and maybe the CFPB. I don't know that we'll see the White House really step into all that. We may. But look, as I say, I think it's great that they did this because it's clearly they're paying a lot more attention to the whole industry. And, you know, we need some movement. I think Congress is probably going to take up stablecoins first. Senator Toomey came out with a proposal just this week, and there's a lot of other ideas about that. But there are, you know, more and more people getting interested in regulation of crypto generally, which is good.
Yeah, I think it was just a really powerful signal that crypto is here to stay and America wants to lead, which if you consider the fact that this asset class was invented, you know, a little over 10 years ago, that's an amazing thing to have accomplished. So I think it's really important to acknowledge how far it's come and how serious America is taking it now.
Well, that's pretty much what I heard from the industry, that there was a lot of positive reaction to it. And I think the main frustration was there wasn't a lot of regulatory clarity necessarily, and some of these reports are going to take months, so that's still going to be pushed out a little bit.
I think it's good policymaking, though. You want to take time, you know, do the studies, gather the information. I'll take that over regulation by enforcement any day.
It's interesting, though. The EO was almost a bit of a Rorschach test, and everybody saw what they wanted to see in it. But no, I think the studies are good. And again, the focus on this and trying to take an across the government focus and kind of thinking about innovation generally, is very good. So we'll now await the studies and see what happens next.
Well, and so I guess in the meantime, if we're not seeing regulation, where do you think some of that clarity could come from? Obviously, the SEC has been carrying out a lot of enforcement, so maybe there?
Well, yeah, I think we'll continue to see enforcement actions. Enforcement is not the best way to set standards for, a new industry like this, because enforcement cases take time. They're, specific to a particular situation. Whatever is the result, has applicability, but it's not always clear exactly what that applicability is, and there's no public process for comment. So it's not the most efficient way to get at what we need. I'm hoping that the industry can maybe, work on some voluntary measures that can develop some standards that then maybe Congress could endorse some broad principles. I mean, I wouldn't want to see Congress try to draft, rules here, but, what happened with the Jobs Act, which is now 10 years old, where we created the crowdfunding exception, is not a bad precedent. There were some high-level principles for crowdfunding, and then the SEC was given the job of developing regulation. So if the industry can come up with some standards that say the exchanges would follow, or that even DeFi platforms would agree to incorporate as they launch, that would be helpful too.
Yeah, I agree absolutely. I think so. 2 points. Like one, thinking about the securities industry and the Maloney Act in 1938, right? Like that's about self-regulatory organizations and the industry coming together and regulate itself. And I know a couple of years ago when the crypto industry was more in its infancy, there were efforts to come together and self-regulate. But now that we have the executive order, which is absolutely signaling to the industry that you are going to be regulated, one. And two, we're now at a $3 trillion industry, it makes sense for these more mature companies to come together and one, educate regulators so that the studies are actually robust and reflect what's going on in the future. And then two, come together and impose standards that actually work for the industry. The big argument is that crypto is different than the typical security, different commodity. The industry should come together and explain, one, how it's different, and then two, the better way to regulate. And I think we're going to see some of that during the comment period. There's a lot of rules that the SEC is proposing that would or arguably could affect the crypto and DeFi industry. And I think through that process and other engagement, we're going to start to see the industry talk to regulators and propose alternatives that are better suited for the industry.
And is there, we pretty much have time for one last question, but is there anything that the industry is keeping a particular eye on? I know the Ripple case is still making its way through the court system, so.
I think overall, regulators have a very tough job, especially with any new innovation like what crypto is. So I think the common theme here is, education, striking that right balance of promoting innovation while also protecting investors and consumers. The White House executive order is a really positive sign that that's where we're going, that really fair and balanced and thoughtful approach. Grayscale is a member and donor of various organizations in DC, like Coin Center and Blockchain Association and Atom, that are really very much behind the scenes having conversations with regulators, with policymakers, to make sure that as they're thinking about this asset class, they're fully considering all considerations and crafting good policy. And I think that's absolutely the right approach we should be striking.
Yeah, I would agree with Tiffany and Craig's last comments. Particularly Tiffany's, that the industry is going to be regulated more than it is today. And again, the sooner the industry kind of widely embraces that and works toward that, the better. The over-the-counter swaps industry, which I was involved in early in my legal career, thought it didn't need to be regulated either. It's different, it's a new technology, it's a new form, it's big boys, we don't need all this regulation. And then, it helped blow up the the financial system. You can argue about its relative effect as a cause, but clearly it made the global financial crisis worse. And so then we came in with regulation. So regulation will happen. It's just a question of how long it takes us to get there.
Yeah, and regulation is how we allow this asset class to flourish in the US.
Absolutely, absolutely. We need it from an investor confidence standpoint and to promote innovation.
All right, well, I think that's a great place to stop. Thank you all so much for joining me today. And I do want to make a quick announcement. So please enjoy the break. We're going to see you all back here at 11 a.m. for our panel with the heads of the New York Stock Exchange and BNYMellonWealth Management. And thanks for joining us.
Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please welcome to the stage CEO of Investor Solutions and Wealth Management Divisions at BNY Mellon, Keating, and President of the NYSE Group and Chair of ICE Fixed Income and Data Services, Lynn Martin, with Bloomberg's Carol Masser.
Well, good morning, everybody. Lynn, Catherine, thank you so much. Thank you, everybody, for being here. And BNY is a sponsor of our event, so thank you for that.
Happy to be.
We're just kind of getting ready in the back and just saying just so much going on in this first quarter, to say the least, right? I just want to throw out some statistics, if I may. More than $3 trillion erased from bond and equity values during that first quarter. We had the S&P peak to trough slide about 13% at its worst. NASDAQ and Russell 2000, we saw bear market declines of 20%. Crude, huge swings. Bitcoin, nickel. You know, unless you were kind of in the commodity space, you did really, it was a rough quarter. So volatility. So Catherine, let me start with you. How did you see the first quarter? Like, how do you kind of sum it up?
Yeah, so volatility obviously is driven by uncertainty, and I think it's fair to say that with the worst global health crisis in 100 years, with the first serious ground war in Europe in 80 years, with the worst inflation in 40 years, and the tightest labor market any of us, I think, have ever seen, there's a lot of uncertainty out there. And so, you know, you focus on what you think will guide you going forward. And so what do we really focus on? We focus first and foremost on inflation and interest rates. Interest rates are the foundation for valuing all financial assets. We focus clearly on geopolitics. We did not anticipate this event in February. Normally, a geopolitical event, markets tend to respond, tend to go down and then rebound very quickly. That's what happened after 9/11. And actually, you did see the market bounce. It was a tough quarter, but it was a better March than February. We look at confidence, right? Because what causes recessions? It's behavior. So we look at CEO confidence, consumer confidence, and we see that in a relatively mid to high range, but coming down. So we watch that. And then the last thing we look for, and you sort of hinted at it with commodity markets, is we look for where could there be leverage in the system. When Russia defaulted in 1998, there was leverage in the system. It turned out it was leveraged currency bets. In 2008, there was leverage in the system. It turned out that it was in mortgages. Do we see that kind of leverage in the system? Not necessarily, but what are we watching closely? To your comments, commodities. Commodities. And leverage matters because that's what tends to lead to a more dramatic decline.
Right. So Lynn, come on in on this, the volatility that we saw in the first quarter.
Yeah, I mean, someone new to her seat. It was a really volatile time to take this seat. And I mean, I look at it from just the intraday swings, the day-on-day swings, and then I also look at it from the perspective of messaging that's hitting our platform. I mean, we had our top 5 messaging days ever happen this past quarter. Right. And you're talking about 500 billion messages a day that we processed across all of our platforms, which is unbelievable when you think about it. And when you really saw that was when you saw, the 1,100 point swings intraday in the S&P or some of the other markets. It feels as though the market, though, is starting to come to grips with the volatility. They're starting to take a position that perhaps the Fed is going to do what it's been telegraphing it's going to do. I think maybe the Fed raising a quarter basis points in March gave the market a bit of confidence to trust what was being forecasted there. So we do see volatility starting to abate.
Right.
And from my perspective, I have to look at it from 2 different perspectives. I got to look at it from our markets, but I also have to look at it from the IPO pipeline.
How's that going?
Yeah, and volatility, as you can imagine, when there's a lot of uncertainty in markets, volatility is going to weigh on those companies who are looking to go public because, they're a bit cautious about bringing their companies to market at a time when they can have these huge intraday and day-on-day swings. A big indicator that the CEOs that I'm talking to who are planning to come to market, that they're looking at is the VIX and how that is starting to behave. When you see it go below 20, that's when the CEOs that are in our pipeline are like, yeah, maybe I can now start to think about coming to market.
And we ended the quarter just around 20.
Correct. Right. I think a couple of weeks ago was the first time that we saw it dip below. So having a lot of conversations with those companies that we know are part of our pipeline.
One thing I thought about in terms of the first quarter, there's volatility and then there's chaos, right? We've seen chaos in the financial markets. I mean, let's go back to the financial crisis and other times where you really felt like, oh my God, the system is coming undone. It's an important distinction because I think about the exchange. It functioned, right?
Absolutely. And I think about 2 years ago, in particular, when you had the pandemic, when we triggered in the US equity markets the market-wide circuit breakers, which are a halt when the S&P dips below 7%, and then reopens, and then further dips. We had to halt the market 4 times during that period. We haven't had to halt the market. This is just the market finding its footing. And you know, our job as an infrastructure provider, as a marketplace, is during times like this, we need to remain open, we need to have orderly trading, we need to have efficient trading, because we need buyers to meet sellers, sellers to meet buyers, and to do so in an efficient fashion.
We say it a lot, but markets go up and down. Catherine, come on in on this, because I do wonder, like, was all of a sudden everybody, again, getting to this point of chaos versus volatility, were all the clients at BNYMellon, you know, calling up and saying, I want cash only?
No, and in fact, what you see is that there wasn't chaos in the markets. It was actually a very interesting kind of leveling quarter, because it almost didn't matter whether you are 100% in stocks, the S&P 500, or 100% in bonds. Your portfolio probably lost about 5%.
Right.
So that's not chaos. That's
the
normal.
60-40 didn't do so well.
Actually, it was a combination of the two. It did about the same, right? And so what was unusual about the quarter was it was such a tough quarter in the bond market, right? Because you had interest rates rising so quickly, and then you had something that typically doesn't happen. You had spreads widen at a time when the economy is actually doing quite well, right? Spreads usually widen when the economy is not doing well, but you had both of those at a time that you didn't have enough, the rates were so low you didn't have any yield to protect you. So we think that is beginning to start to reverse in this quarter, but everybody's pretty much in the same position at the end of the quarter. Most likely, your portfolios were down about 5%, and given all of these big uncertain issues out there, that's actually a very resilient outcome.
Well, this is what I wanted to ask you about some of the volatility triggers. Like we mentioned them, geopolitical tensions, China versus the US, China versus the world, inflation, inverted yield curves, innovation disrupting itself. You guys have been moving increasingly into whether it's the crypto world, the NFT world. What among what some might consider volatility triggers kind of concern you the most, Catherine?
So it's the things that I mentioned earlier, right? We can't control any of these things, but I think that there is a path to a soft landing from all of this, and the path probably includes a couple of things. Obviously, it's the Fed tightening rates, but not too much. It is companies doing what companies do, which is managing through this uncertainty. We have, company profit margins at all-time highs. We've seen a tremendous spike in productivity over the pandemic. That helps corporate results. And we need consumers to do what consumers do. And there's an expression, high prices are the cure for high prices to a certain extent. And what we need the consumers to do is shift a bit how they've been spending, which is on goods, right? All the things that people did to work from home and renovate their homes and all of that, and shift a little bit to services. And then I think there is a path to a soft landing from this.
Yeah, I would agree with that. This is not the first time there has been volatility, to your point earlier, in markets and uncertainty in markets. And markets are resilient. And our markets in the US are the envy of global markets, given the access, given the investor protections they provide, given the types of companies and the transparency that those companies provide when they are public.
Right.
So we've been here before, and we've been here under less of a crisis, if you will. This is not the financial crisis. It's not, the start of the pandemic when there was a tremendous amount of uncertainty.
Feel uncomfortable.
Yeah, it did.
And volatility doesn't necessarily mean negative returns, right? The average intra-year correction of the S&P 500 over since the 1980s is about 14%. And yet, so 14% dip at some point in the year, and yet 75% of the time, the market ends up. Rising interest rates does not necessarily mean negative market returns. It might mean lower market returns, but if we look at the sort of 10 rate hiking cycles since the 1960s, 8 of them have actually had positive returns, including the most recent.
And typically often means the economy getting back to normal. One thing I want to ask you though, when we talk about like inflation, there is a generation of investors that don't necessarily understand high inflation or 17%
We're all
mortgage
calling
rates.
Our parents,
yeah, exactly. We did actually a Twitter poll, and I want to bring it up for everybody because we asked on inflation, can the U.S. return to 2% inflation without a recession? And as you can see from the results, an overwhelmingly response of no, almost 71%. Do you all agree with that? Yes. Do you agree with that? Lynn, do you agree with that?
It's interesting how sentiment tends to drive markets, though, too. And I think that is a new phenomena that you've seen with social media and how that perception may be driving different things in markets, different market behavior, as opposed to fundamentals of market. I always come back to fundamentals of economies, and does the economy have a capacity for growth? And this economy does have a capacity for growth. However, sentiment has become a very important driver of what you see in markets.
But to your poll, I would ask a different question, which is, do we have to? Do we have to revert to 2% inflation? And we don't actually think that we do. For most of our investing lifetimes, we had 3 to 4% inflation a year and markets did just fine. We've always thought that inflation wasn't transitory, it's transitional, and it's transitional to a new normal that'll be a bit higher than what we've had since the financial crisis. But that 3 to 4% inflation, markets can do just fine. Businesses can raise prices. They can raise wages a little bit. Consumers can buy a little more.
Wouldn't be bad for a lot of workers to get some higher wages, right?
It can do just fine. And to your point, you're exactly right. It's the economic ecosystem that all of this happens in that matters. And we've just come through an extraordinary time, right? We had 55% of the global economy closing down in a single month, and the fastest and steepest decline ever, and yet roaring back thanks to all the stimulus that our government and governments around the world provided. And so we actually came out of this recession for the first time ever with no income loss. What normally happens in a recession? People's incomes go down. Not any quintile of income earner in this country had their incomes go down during this recession. So the economic ecosystem is very strong. Corporate America is very strong, all-time high profit margins, and growing productivity, which is also something that didn't really happen over the last 20 years. And so there is capacity, I think, for growth here.
And to your point earlier, jobs. Think about how many of us in corporate America are looking to fill jobs. It's a hot employment market.
That's right.
That doesn't necessarily feel like a market that's going to head into a recession.
It's interesting that you say that because we talk so much about the inversion of the yield curve right now, and everybody says, okay, that's recession. Well, maybe we need to think about what causes, what's the root of a recession? And we right now have a strong labor market. You talk about earnings growth. There's a lot of things, strong balance sheets, whether it's the corporate world or households. One thing I do want to do, let's ask your question. Do we need to go back to 2% inflation in your view? Yes. Raise your hand. No. So there you go. Okay, that's interesting. All right. So then let's think about some other, so the outlook then, do you anticipate there's more volatility? Like, is there something going on? I mean, there's a lot going on. But I do think about, I know in our planning call, we talked about things like, of course, what's going on geopolitically.
Yeah.
Nobody really thought about that late last year.
Yep.
The energy market, you're seeing how people are rethinking how they do things. Supply chains, we just had a CEO on, moving stuff from Asia increasingly to Latin America. So are there some major things going on that are going to, or technology, I think about, Lynn, that are going to create bouts of volatility within our financial market?
I think that volatility is something.
Read it already, Robinhood has done it.
I think volatility is going to be something that markets live with in general, because markets go through transitions. Businesses go through transitions. They always have. It's just the electronic marketplaces that we operate today just react a bit differently to those transitions. You mentioned energy. We're in the process of going through a transition to cleaner, greener energy. That's going to cause probably some volatility around energy and oil prices for some time. And that's probably okay, because at the end of the day, we're going to move to a cleaner, greener energy future. So I think coming to grips with the fact that there will be some volatility in markets, and volatility is just part of transitions of economies, as opposed to always thinking volatility is bad.
Right.
I think that's probably the right way for the investor to think about these markets.
That's right, and absent a real risk of a recession, volatility and downward shifts in the market have proven to be buying opportunities over the years. So you have to ask yourself, how likely do we think it is that there'll be a recession in the US this year? And I think most of us would say probably not so likely because of all of the things that we talked about. And there is a lot of support for equity markets right now, right? There's a lot of cash still sitting on the sidelines. The consumer is healthy and spending money. Companies are doing very well. So the risk, I think, of a recession in this country this year is probably pretty low, which means that when you do see that downward volatility, it's actually an opportunity to rebalance your portfolio and get back to the sort of neutral weight that you want to have in equity markets.
Well, that's what I wanted to ask you about your clients, Catherine. Like, what are the questions that they keep peppering you with in terms of their portfolios and what you're either the changes you're making or that you're maybe not?
Yeah, so before I talk about our clients, maybe I talk about, clients broadly, because, we, during our careers, have lived through a dramatic shift in financial markets that's all stemmed by a change in how we save for retirement, right? Our parents' generation, they probably retired with a pension plan and whatever savings they'd accumulated and were working with their wealth manager. For most of us today, that's no longer the case. We're not going to retire with a pension plan. We're going to retire, with our savings, which means that we're responsible for our financial futures and our retirement. And so what we try to say to our clients is, we have to make sure that we have the same institutional disciplines that a chief financial officer or a chief investment officer of a pension plan would have, and we have to have them in wealth management. And what does that mean? It means you kind of need the same policies, right? Every institutional investor has an investment policy statement. Every single one. If you're a pension plan, an endowment, you've got an investment policy statement. And the reason you have it is the policy protects you. It takes the emotion out of what you're doing. So we have investment policy statements for our clients, and that means that when there's a real market decline, as there was in March of 2020, we rebalanced. And that makes a big difference, and it's not what you're seeing the typical retail investor do. In fact, you had asked me that question on Friday, so I looked up the industry flows. So if you start from the beginning of January 2020 through the end of March of this year, right, that 2-year and 1-quarter period, the S&P 500 was up 40%. The bond market, I'll pick municipals because our clients pay taxes, was up about 3%. Inflation was up about 8%. And we look at a proxy for how did retail investors invest. We look at ETF flows and mutual fund flows because they often invest in those categories. And what did the retail investor do during that time? Invested $1 trillion in the bond market. $1 trillion. Municipals or the Barclays Ag, by the way, up around 3% with 8% inflation, so negative real returns. So there was a fear of being back in, while this market had a strong rebound, and that's one of the things that we as the industry have to help our clients with.
And understand. One thing I wanted to ask you, Lynn, we talked about the IPO market, and you're talking to CEOs.
Yeah.
What about the SPAC market, which was on fire earlier last year?
Yeah.
It's been a much tougher space.
Yeah, it's been I'd say everyone coming to market right now is a bit more cautious. The SEC just issued new rulemaking around SPACs, which we're still digesting. It's been a very busy time for the SEC with a variety of rulemakings, so we're still digesting what that means. But, on balance, adding additional transparency we think is a good thing.
Yeah.
And at the end of the day, it's not a surprise to us that yet another way for a company to go public, traditional IPO, direct listing, which is something we pioneered in 2018, and now SPACs have additional rules placed upon it because of the popularity of the vehicle. We still think it's a very, very viable way for a company to come to market. So,
do you think once we get more clarity from the SEC or that we start to see it pick up again?
Yeah, I think we will continue. I think what we'll see is well-governed SPACs continue to come to market. That will be high-quality SPACs. It'll be the types of entities that are known to the market, known institutional investors will continue to come to market that way, and there'll be a lot of great companies that wind up becoming public, transparent companies as a result of business combinations resulting from SPACs. So at the end of the day, we think this is only going to further give another set of rules to this asset class.
I always love watching the startup community, and I feel like in companies coming to public, to me, that's, as you say, a sign of confidence of what's going on in the economy. So what is, and I want to get it from both of you, because I know you watch it as well. I mean, what does it tell you about kind of what's to come later on this year?
Related to SPACs?
And IPOs, and just watching.
You know, the amount of innovation in this economy, look how we just got through the last 2 years, right? None of us are doing anything the same way. We aren't shopping the same way. We aren't accessing the markets the same way. So there's just been this tremendous surge of innovation, and so we do expect to see more companies coming to market. When it comes to SPACs specifically, they're a more complicated investment in a way, right? Because on the one hand, it's an IPO. Yep. We understand IPOs and going public, but on the other hand, when they, quote, de-SPAC, it's typically acquiring a private equity-backed company and going public. So it has these elements of both an IPO and investing in private equity. Private equity funds have done very well over time, but one reason is that they're diversified, right? They're not a single company. So we look at SPACs as single company investments, often in new companies, but you want to be diversified as an investor.
Can we talk technology?
Yeah.
Can we talk crypto?
Sure.
Can we talk the metaverse?
Sure.
Can we talk NFTs?
Sure.
Can we talk T0?
It's every tech buzzword all in a sentence.
Like we said, there's nothing going on. I know. There's so much. You guys have been making investments, doing patents, filing. How are you thinking about this for the future?
It's an interesting space that we're trying to get smarter around.
We all are, right?
Yeah, and it's pretty similar to a playbook that we had at ICE back in 2015 when we made a $10 million investment in Coinbase, which we wound up selling after it went public for $1.2 billion. So not too bad a return. If only everyone's portfolio could yield that type of return. I think it's a rapidly evolving space, and there are elements of technology that make processes much more efficient, make them much more transparent, and NFTs and the metaverse and these newer technologies are areas that we want to get smarter about. It's why we put one of our top executives, one of the people that actually started ICE, as the CEO of T0, which is a company we just invested in, because someone that we trust and we know we're going to get a lot smarter about. So it's an area we're watching with great interest. Yeah.
Well, go ahead.
And I think all of these segments are just examples of the innovation that we've seen over the last 2 years. With NFTs, I find it just fascinating. If you think about the art market, right? Okay, galleries closed, museums closed, can't have in-person auctions, and yet, the market has adapted, and we now have NFTs, and of course, it's early, and there are issues around, trademark and durability and all of that, but it's just an example of this tremendous capacity for innovation in this economy.
But that's, to your point earlier, Catherine, that's where we see the market being able to reward innovation through the IPO market. The amount of companies that are out there are just phenomenal, and they're companies that have changed the world and rapidly evolved and seized the opportunities that the pandemic and us not being connected physically, but the opportunity to be connected virtually. So that's why we tend to be bullish about the IPO market. And remember, 2019 we started the year with the government shutdown. 2020 we had the pandemic. Not a lot of IPOs during either one of those periods of time.
Right.
So some volatility to start this year, from our perspective, is not that dissimilar to what we saw in both of those years. And given our market model, which is focused on blending the humans alongside the technology, we think we're uniquely poised at the New York Stock Exchange to help companies go public in the back part of this year.
And you asked us, what are our clients asking us? Well, as we were emerging from the pandemic, what our clients were asking us, everybody tries to think about history and how you can be informed by history, and we're a historic company, obviously.
Yeah, of course.
We've been around together
I think
for
we
a
little bit of history.
New York Stock Exchange and Bank of New York Mellon, yes. They would ask us, well, is this going to be like the Roaring 20s, right? We're coming out of a pandemic just like we were a century ago. Is this going to be like the Roaring 20s? Fast forward to the first quarter this year, they say to us, is this going to be like the 1970s? Is it going to be like the 1970s?
Right.
And actually, we would not be surprised if this ended up more like a decade in between, which is the 1950s. Coming out, again, of a terrible global crisis, very indebted governments. And what did you see? You saw that, the greatest generation, forming households, tremendous growth in the economy, innovation, the national highway system, infrastructure investments, all of those things, actually a very good economy. And we see that today. And by the way, we forget how important generations are to the economy and markets.
Yep.
That generation, the post-war generation forming households, very, very good for the economy. Baby boomers, their kids in the 80s and 90s, very good. Now we have the millennials. Now we have the millennials forming households.
Right, who weren't going to buy houses and weren't going to invest, and now they're doing it.
But they are.
All right, so we have about a minute and a half left here. You guys have a lot of optimism. I can feel it, right?
I hope it's realism. I hope it's realism.
No, okay, fair. So
optimistically realistic.
Well, so Lynn, there's a lot of things that could go wrong.
Yeah.
Sorry, who laughed? Who snickered? I heard that. But you know what I mean? So what is the thing that you think we as investors kind of need to really keep on our radar?
I think
there's a list.
New York Stock Exchange turns 230 years old this year. It's been through crises, it's been through wars, it's been through pandemics.
Feels like a war right now, like it's a little loud out there.
Exactly, it's a little loud out there. We have withstood the test of time. And if you think about the US equity market system, the rules that have been developed, the transparency that has been developed, every time there's been a crisis, there's another rulemaking that adds just another layer of transparency or another safeguard. That's taken 200 plus years to develop. We've withstood these before. So I tend to be very optimistic about the fact that our markets have been tried, true, tested through the most tough crises.
And we turned 238 years old this year at my company. So again, together for a long time.
You don't look a day over 237.
I know. Thank you.
You don't look a day over 229. So.
But what do we know? Over this long period, markets tend to gradually rise over time. Time is your biggest asset as an investor. If you have a long time horizon, you may not be rewarded every day, but you will be rewarded over time. If your time horizon is short, that's a little different. Make sure you've got cash and you can, support whatever it is you need. But time is a big asset as an investor.
All right, I'm going to do really quick because I know we have to wrap. So if I had to say one thing that people should watch on the downside or concern, what would it be? Just one thing, quick.
I think the Fed raises, I think, is something to just watch.
I would agree with that because that can cause a recession. And the other thing I would watch, and we're trying to watch carefully, is leverage in the system because that can really cause something, even worse for markets.
All right, you guys, thank you so much. Lynn, Catherine, thank you. Everybody, thank you so much.
Thank you.
Thank you.
Please welcome to the stage Partner and Chief Client and Product Development Officer at Apollo, Stephanie Drescher with Bloomberg Shanali Bosek.
Thank you all again for being here. And Stephanie, thank you so much for being here.
Thank you.
I want to point out that Stephanie has gotten a new role at Apollo just last May to oversee wealth. And in that time, Apollo has hired 150 people nearly for her team. So with that many, that's a lot of people. With that many people, what is the goal here? It used to take $5 million, $10 million to get into a private equity fund, to get into a flagship fund.
Right.
How is that going to change?
Right. So, look, great to see you again. So when we think about the investors that are eligible for alternatives today, the landscape has changed pretty dramatically. So you're right. It used to be qualified purchasers, ultra high net worth only, and we still are focusing on their needs and solutions for them. But you can go all the way through to the mass affluent now. And there, you can subscribe for $2,500, point and click. Very different than the piles of paper that we used to see. So the spectrum of what we can offer to the ultra high net worth, the accredited investor through to the mass affluent has evolved meaningfully. And so when you look even at that semi-liquid, kind of the private BDCs, the private REITs, instead of the 5 to 10 million of suitability, you're at 250,000. And the idea is to provide much greater access.
So this is a very large shift, and it's been happening for some time. You have Blackstone, you have KKR, you guys now really getting into this private high net worth segment. So what's available now, and what might be more available in the future in terms of what's going to be investable?
So if you look even at Apollo a year ago, and what a difference a year makes, we had 0 perpetual product. Plenty of more episodic opportunities, a wide range across strategies, but none that were perpetual. Now we already have 3. I think by the end of the year we'll have, my guess is about 6. And the range of what we can provide in terms of what investors are looking for has changed. So when you look at the markets today, and I know we've heard a lot about it throughout today's session, the clients, the financial advisors and their underlying clients are looking at rising interest rates. They're looking at the potential inflationary environment. We're looking at volatility. And ultimately, when we look at kind of the historical 60-40 model that people have relied on, it's challenged going forward. And so looking to alts as a tool is critical.
So how much of this is happening because of the environment that we're in, and how much of this is happening because if you look at where so much wealth has been created over time, so much of it has been in private markets and so many people have been left out?
Mm-hmm. Yeah, look, the democratization of alternatives is real, and being able to provide institutional quality opportunities to individuals through financial advisors is absolutely what we and certainly others are looking to do. The important part is in our view, alternatives is not just the traditional definition of private equity. And I know kind of historically it may have been kind of a more narrow definition. We think about alternatives as simply an alternative to public equity or public debt. And that's very important in this environment to be able to allow the investors to achieve their financial goals, whether that's saving for retirement or building wealth. This is a critical tool to help them get there. And the size of the market, which you're referring to, is practically double that of what we see in the institutional market, yet it's massively underallocated to alternatives. So there's a mismatch, and the products are
people
meeting their
saying
needs.
to you then, let's take the 60-40, a lot of this is not working, particularly that bond allocation, and saying let's give it to you instead?
They're looking for fixed income replacements. And in this type of backdrop that we mentioned, making sure, yes, that we work with them to find opportunities to fill that piece of their portfolio, as well as kind of reimagining what they can do with equity as well.
Well, the equity part of it is interesting because of the volatility that we've been seeing in the equity markets. Has that changed the conversation with clients at all in terms of seeking private equity opportunities relative to ones that are in the public markets?
Absolutely. So being able to deliver excess return at each point of the spectrum is our focus, and investors are absolutely looking to us to do that. And when you think about their pain points, we want to develop solutions that provide the diversification to alternatives in as efficient a way as possible, and offering it in a way that's highly aligned with how we invest our own capital. And so I think you'll see more and more of that going forward.
But I think that's another big question a lot of people who are entering the space have. When they're investing with Apollo, when they're investing with private asset managers, how are they treated as an individual vis-a-vis the big institutional investor, which has a lot of leverage when it comes to fees?
Look, our view is that historically, I think the fee arrangements were quite different from where we are today. And our view is, along the lines of efficiency, to make this as seamless as possible, including fees, and being quite fair in terms of the access and the price points for individual investors. So I think when you look at our products and that of the marketplace today, it's evolved in a very positive way for investors.
Now, going back to the types of products that are made available, this year, in 3 months, you raised, through the retail channel alone, about $2 billion in 3 months for a BDC. How does that compare? And you've been in this world your entire career, back at JP Morgan and now also at Apollo. How does that kind of fundraising for a private credit product compare to any type of fundraising you've really done before?
It's lightning speed. And I think it shows the demand that we're seeing from the financial advisors to be able to create yield in a defensive way. So when we look at the strategies that we're delivering, it's senior in the capital structure, it's floating in an interest rate environment, obviously that is rising, and it can create a very defensive role in a client's portfolio. So it is, from my experience, at record pace.
So how much is this also the kind of not just democratization of private assets, but this idea that I'm going to steal from Matt Brown over at Case, the idea that private assets, private equity funds can be as easy one day to invest in as a mutual fund?
Right. So we are big believers in that intersection of offering alternatives as well as the technology advancements. So you've seen our several investments that we've made in Motive Partners, in Figure, in Case and iCapital, and the idea is to make it easier and easier. And so that stack of paper that I referred to earlier, which is not necessarily an easy experience, is already getting more and more efficient through the use of technology. And I am a believer. I think it's a matter of when, not if, that it can be a simple click.
When you say a simple click, are you saying, one day you're going to be buying Apollo funds on your iPhone?
One day.
So, I mean, how long, this is not the Apollo that most people are used to. So how long does it take to transition to that kind of a future? And also, what role does financial technology play, given you've made such huge investments in so many fintech firms?
Yeah. Look, I think we're certainly focusing on it. I think the innovation and the great minds that are focused on this area will make advancements. Our view is to make sure that we partner with really forward-thinking members of the fintech community and those that are delivering great services today to investors, and just make sure that we are there as part of the evolution.
So another thing here I want to address is, we talked about the role of private equity and private credit when it comes to volatility. It's not that there's no volatility in private markets. In fact, your money is locked up longer. So how do you protect against that? I mean, what are the warning signs that investors should be really looking out for when it comes to private markets?
Look, I think part of it is the basics of manager selection. I mean, we need to make sure they're obviously with managers that have been able to navigate cycles, and certainly at Apollo, that's something that we really pride ourselves on over kind of 30 years at this point. And it's making sure that if it's more on the kind of fixed income replacement side, that the portfolio is akin to the risk you're looking to take in that piece of your portfolio. And from our perspective, there's a whole range, obviously, of risk and return. As I mentioned earlier, if you're looking at credit replacement versus equity, you're going to take a different approach. But our view is if you get the manager right and it's someone that can be nimble and navigate the markets effectively, then you're not at the whim of liquidations or sales as you would in a public market environment. You can really pick your spots with entry and exit and make sure that you're maximizing value with someone that you trust to work on your behalf.
When it comes to manager selection too, you've done a lot of work, you've acquired Griffin here. How do you think about your work with the wirehouses and the RIAs out there?
Yeah, so look, partnerships for us across the wealth channel has been key to our strategy. So we have deep relationships with great momentum in the short period of time that we've made this really a strategic priority for the firm. The relationships run a long time, but the dedicated resources that we've built, as you said, from basically 1 a year ago to 150 today is a sign of our commitment for sure. So the spectrum is from wires and private banks to the independent broker-dealer channel. The acquisition of Griffin was a key part of that. And I think a distinguishing factor for us and kind of the range of relationships that we can interface with. Registered investment advisors, also a key element of our strategy. And you'll see us continue to enhance our family office resources as well. And we think of it globally, across US, Europe, and Asia.
You yourself came a while ago, 18 years ago, from JP Morgan to Apollo. But now, when you've hired those 150 people, they've come from Goldman, they've come from HSBC, they've come from Barings, they've come from T. Rowe, they've come from all over the industry. And I'm wondering if you have an idea of what this says about the way the industry is moving. Do you think that more talent is going to be moving into wealth, as well as private wealth more particularly?
Yeah, look, it's been fun, and the team that has come together is super talented and so excited to kind of work together because the opportunity is massive. I think the ability to make sure that we're providing solutions for what investors are asking for, particularly now in this market environment where purchase price matters. I mean, you've seen the markets over a long period of time, and for the last decade, purchase price hasn't mattered because we've been in a bull market and all boats have been lifted. Thankfully, it's always been in our DNA. So as we approach this opportunity set for the global wealth channel, it feels like it's the absolute right time to bring a fabulous team together, which has been my privilege to be able to build, coupled with our capability as a firm at a time where purchase price matters.
This might also change the texture of Apollo's investor base. Last year, your CEO had mentioned that, or you had mentioned actually, that 30% or more over time of all new money that comes into Apollo can come from the global wealth channel. Last year was 5%. How much has it increased already?
So we have a lot of momentum, and it absolutely has increased. So we were at that 5% level last year. We're on track, given our pipeline for 22, to meet the kind of public goals that we've set out there, which from an AUM from wealth standpoint is multiples of where we were last year. And going forward, I stick to what I said at Investor Day, that I do think that the composition of our investor base could absolutely be 30% plus going forward from the wealth channel.
I want to be clear also that your investor base now is very global. And so when you're looking around the world, I'm wondering, where are you finding the investors that are most interested in private assets? Is there more interest in China, for example, than there is in the United States?
It's absolutely global. I mean, the interest from financial advisors that serve their clients, as well as the kind of ultra high net worth through family offices, et cetera, I would say it's a global footprint in terms of the interest that they have. US and Asia absolutely has shown meaningful kind of allocations. Many parts of Europe, though, the same. And a trend that we are seeing, like for the moment, I would say the majority of the products that are directed towards the wealth channel are global in nature and then offered to each of the respective regions. as you see kind of the opportunities develop, I think you will see more local to local. So opportunities in each of the respective regions offered to those clients within that region. And that's something that we're focused on as well.
Now, given a lot of those regions that you mentioned have so much uncertainty, so when you talk to those clients, when you talk to advisors in those regions, what are they most looking for in terms of their investments, and what role do you play there?
Yeah, so we're in a conversation for sure. I think what you find with Apollo in general is that while we have great expertise to offer, we also have a lot of humility in making sure we listen to what issues our investors are looking to solve. And at this time in the market, what we hear a lot of are some of the themes that we started to touch on earlier, which is how do you navigate the market of today with rates, with inflation, with kind of the volatility and expectations from public and equity and debt markets to be lower than obviously what has been experienced and seen historically. And so it's a great opportunity for us then to speak about how we can play a role in fixed income replacement and how we can reimagine how they allocate to equity by using alternatives. And that's a critical tool as they look to generate their return going forward.
Do you face questions at all about taking on risk in this environment when so many people are stepping back and just kind of holding on to cash?
So that's where the trust comes into play, and finding the right manager to be able to navigate that. And scale is very important. So when we look at managers that have scale in a particular strategy and can see a range of investment opportunities across cycles and have the conviction to be able to make investments at the right time, exit kind of at an attractive time, that's where the investor looks to us.
So 18 years at Apollo, but 1 year on this job. So where do you see it going in the next year or so? What are your biggest goals kind of going into next year?
Yeah. So look, we spoke a lot about the channels a bit earlier, and that's a key part, making sure that we have the right relationships with our partners in the financial advisory community. But the expectation, our commitment, is to deliver the best in-class client experience. And to us, that means delivering the firm, whether that's thought leadership and our views on the markets, our views on strategy, or even the kind of fundamentals of alternatives in a portfolio. We want to be that provider and that partner to them, as well as just making it as easy and efficient for them to invest in our strategies and continuing to innovate, because the innovation is in our DNA. And I do believe that you're going to see some revolutionized product come to wealth based on the resources that we're committing internally to bring that to the financial advisors.
I mean, I also have to say, too, I mean, this is a year where it's going to be a record year of fundraising for Apollo. Right. So are we going to see flagship products being brought out with a significant amount of, I think you said $2,500 investment?
It can be as low. And we have one interval fund, too, actually, that are focused in credit and in real estate already that allow for that type of access and suitability. From a flagship perspective, we do have our private equity flagship strategy out in market now, and our view is to make sure that it's accessible. That's part of what we're focused on, making sure that we take our institutional quality offerings across strategies and ensure that everyone from the ultra high net worth ultimately through to the mass affluent can have that experience.
It's definitely a new Apollo. Stephanie, thank you so much for your time, and thank you all for listening.
Thank you.
In sales, timing is everything. So nothing beats having the insight to be there when it matters most. With LinkedIn Sales Navigator, real-time data gives you the most up-to-date insights so you can reach the right customers at the right time.
Please welcome to the stage Edward Jones team leader Cully Eisenbeis with LinkedIn Sales Solutions Major Accounts leader Matt Repking.
So I want to begin, Cully, by just thanking you and Edward Jones for being such great partners for LinkedIn. Excited to have a chat today.
Yeah, thank you, everybody.
Yeah. Lot of conversation today about opportunities in the market, right? Opportunities for investors, but also opportunities for wealth management firms. And as we think about this opportunity set, at LinkedIn, we've recently commissioned some research, really looking at investor attitudes, and have been really fascinated by some of the results. So first of all, finding that something in the neighborhood of 31% of investors actively looking for a new advisor or wealth manager in the next 12 months, 31%. Finding that folks are saying 39% of a firm and or advisor's social media presence is critical to that relationship. That number was 12% in 2016. Clearly our advisors are not our parents' advisors. How is Edward Jones thinking about this?
Well, I hear those stats, and as a marketer at a financial services firm, I cannot be more excited to hear those types of numbers. But it's also, when we think about Edward Jones as a 100-year-old financial services firm, it makes us really think about what are we doing to bring in new clients, and how are we activating our 19,000 financial advisors to use digital tools to identify their ideal clients through tools like LinkedIn, and then send them the right types of messages to help them understand how we can really support them through their financial needs. One of the things, when we were talking backstage, you mentioned 75% of people on LinkedIn are not connected with someone who has financial advisor in their title. So the white space, when I talk with our financial advisors, that's my hook for them, is to say the white space out here to identify clients and use that to bring them in, new investors, new clients, or thinking about the generational wealth transfer. I had a annual meeting with my financial advisor a couple of weeks ago. My wife and I did. I got there early and I said, what are you thinking about? And she said, my clients are older. How do I find the next client? How do I talk to my clients' children about the opportunity at Edward Jones?
Great. LinkedIn, as you know, right, has the most affluent member base of any of the social networks, right? The most investable assets. So to your point, if you're not on the platform, you're missing those opportunities. But investors becoming more and more comfortable with social, with digital, right? And we're seeing firms that are investing huge amounts of money in digital investment platforms, perhaps not investing as much in digital interaction channels, things like social. That's the next frontier. And we're seeing leading firms like Edward Jones, right, that really recognize your presence online is driving the brand and driving perceptions of the brand. So curious, how are you thinking about that? And specifically, what challenges do you see in unlocking more from your social program?
Yeah, so like I mentioned, of our 19,000 financial advisors, about 15,000 or so are using social media for business purposes. And when we think about our presence and how are we using this to keep clients informed, feeling secure and engaged with our financial advisors, I go back to this one story about my dad. Personal story here. I told him about 3.5 years ago I was going to go to work at Edward Jones with social media. We've been clients of Edward Jones for a long time. And he said, okay, let me know how that goes. And he said, I think we just got email from my advisor a couple of years ago. So fast forward to the pandemic, my dad calls me and he's like, I got to tell you something. I was scrolling through, now this is a Facebook example, but I was scrolling through Facebook.
We'll forget
that. I was scrolling through Facebook and I came across our financial advisor. He had posted something about market volatility, which we've heard a lot about today. And I said, well, what'd you do? He said, I clicked on the article, I read it, and then I called our financial advisor. He's like, I cannot determine what is real news, what is fake news, what is artificial news, whatever the buzzwords are. He's like, but I know that our financial advisor and Edward Jones are publishing the types of content that are backed in a history and something that we can feel good about. And so whenever I'm talking with our financial advisors about the opportunity with social media, with platforms like LinkedIn and LinkedIn Sales Navigator, I say, that's my dad. He's a 65-year-old man scrolling through social media and feels like hey, I can trust this type of content that's out there and feel good about it.
Sure. Yeah, this concept of being out there and delivering insights is all about building trust, especially times of volatility. And I think firms like yourselves are really leading edge in terms of how do we use platforms and these newer media platforms to connect with advisors, but also connect with investors, but also prospective clients, right? So I know you're going to be around for lunch, as am I. Would love to talk to folks, anyone interested in talking about the power of LinkedIn and how it can help you grow your firms. So enjoy lunch.
Please welcome to the stage Chief Administrative Officer of Bridgewater, Richard Falkenrath, with Bloomberg's Eric Schatzker.
Hi, everybody. I think it's technically still good morning, but it's about to be good afternoon. Welcome to our session on risks you can't afford to ignore. I'm Eric Schatzker, and this is my old friend, Richard Falkenrath. He's the Chief Administrative Officer at Bridgewater. And folks, you may be saying to yourselves, Bridgewater, okay, risk, Bridgewater, I get that part. But what on earth does the Chief Administrative Officer know about risk? Well, I'm going to share with you to begin with a few snippets from Richard's bio. For starters, he has a PhD in war studies. He taught at Harvard's Kennedy School. He was Deputy Homeland Security Advisor to President George W. Bush and served as Director of Proliferation Strategy, and that's not rabbit proliferation, at the National Security Council. He then served as Deputy Commissioner for Counterterrorism at the New York City Police Department. He joined Bridgewater in 2015, served for 6 years as its Chief Security Officer, and since 2020 has been in his current role as CAO. He's a Senior Fellow for National Security at the Council on Foreign Relations and a member of the Aspen Strategy Group. And for a few years, Bloomberg Television was lucky to have Richard as a contributing editor. In short, everybody, if you want to understand risk, there are few better people to consult, which is precisely why Ray Dalio hired Richard and why he's of such value to Bridgewater. Richard, welcome back to Bloomberg.
Happy to be here, Eric, and thanks for that long introduction.
Well, we need to establish some context here. I want to begin with this. Tell us about how you were trained to think about risk and how that thinking has evolved as you took on professional responsibilities for huge societal and now huge operational risks.
So my training initially as an academic in war studies was really to look at all the bad things that could happen through a historical context and to understand them deeply in the situation that they evolved in. And so I was not an empirical political scientist. I was much more of a historically based one. And that attempted to understand the strategic dynamic between contesting entities, mostly states that were had different interests and had to resolve their interests through forms of conflict. Later in life, in the new roles, I've learned that that's a useful basis, but incomplete. And particularly in financial institutions, you need a pretty systematic way to keep track of your risk, to track them, to have a common risk registry, and that they go across a lot of different domains. And each domain requires a lot of nuance to understand well.
What is a risk registry?
Well, a risk registry is common for companies. It's essential listing, often organized by how likely something is to occur and how bad it would be if it occurs, that goes across several domains. And each, sophisticated companies know what their risks are. They wouldn't be surviving if they weren't able to manage risk well. And increasingly, and this is fairly commonplace, you track them centrally. And many boards of directors will deem it as a board responsibility, and we'll have a risk committee whose job it is to know the overall risk picture that a company faces. It is different, Eric, sorry to interrupt, for a nation.
That's all right.
Like doing it for a company is frankly a bit simpler than doing it for a country. And a country that is globally entangled like the United States. And so when you're at the White House, you don't have the luxury of a grid, a matrix, and a tidy taxonomy. You have just an infinite number of things coming at you on a regular basis, every single day.
Since you brought it up, and I think because we're all a little curious, what was that like? And what is it like right now? There is a situation room in the White House right now. Tell us what that experience was like for you and what you imagine and maybe have some insight into what's going on right now.
Well, I was a relatively young person when I was there. I was fortunate to be in the very first day of the Bush administration, but then was there at 9/11. And 9/11 was one of these great geopolitical shocks. I frankly thought it would be the big geopolitical shock of my lifetime. Turned out not to be so much. And so it was a rapid learning experience. And frankly, that event temporarily overwhelmed the ability of the sort of policy process, the decision-making process, to keep track of everything. And it was a period of, for me, absolute unprecedented intensity. And we're now back 20 years. It's really not the focus of this talk. But out of that intensity, the Bush administration did develop a sort of strategic clarity of what it was trying to do. And historians and others will debate the rightness of that strategic purpose. But it was clear. And the president had a narrative, and the entire administration sort of got behind it and pursued it in a coherent way, ultimately. Today, you ask about that. So I'm obviously not there. I know many of the people that are managing, in this case, the Ukraine crisis. They are richly informed by history, and they're not rookies. They have gone through a lot of different crises. They have a lot of experience on this, and they are handling this particular crisis, I think, in a somewhat innovative way, but also in a way that is informed by the larger strategic risks that come into play whenever there is a pure conflict, and a conflict with a nuclear-armed state, which is what we essentially have now.
We're going to come back to the innovative way in which they're managing the situation and also the subject of nuclear weapons in a minute. But before we go there, people in finance, and I'm assuming that most of you here are in finance, are interested in finance, have a tendency to think that all risks can be measured and analyzed quantitatively. In fact, there's an enormous industry, loosely called quant, that dedicates itself to that practice. And the approach works reasonably well for variables that follow patterns, right? Interest rates, perhaps, volatility, or the weather. You specialize in a very different category of risk, the kinds of risks we've all confronted in spades over the past several years, and of course, which we may face again: geopolitics, nukes, as we just mentioned, for the first time since I was a teenager, pandemics, and of course, cyber risks. Do you think of those, Richard, the way that quants might think about them, as black swans or fat tails?
Probably not. There's a big discipline, and there's lots of really sophisticated, smart people in there, so I don't want to generalize across an entire industry. But I think it is fair to say that certain categories of risks, tail risks, things that are extremely rare, don't happen very often, where you have a very small number of events to work with, or things which are strategic in character, where you are dealing with a thinking adversary who is not entirely predictable and is in fact trying to game you just as you were trying to game them. To me, those two things, low-end events and strategic events, really defy easy quantification, and quantification carries with it risks of making mistakes.
Dead wrong.
And being dead wrong. And so in the case of Vladimir Putin's decision to invade Ukraine, that was not a statistical probability. That was a decision, and that a human being made, thinking about the totality of his circumstances. And anyone, I think, who could quantify that and say there's a 30% chance or whatever, I think is kidding themselves. I think you've got to recognize what you're dealing with here, which is a strategic phenomenon that changes based on conditions and based on the decision-making framework of whoever's making the calls.
How do you know where to draw the line? How do you know what to identify as a class of risk that can be quantitated, can be measured and can be analyzed quantitatively, and these things that you're describing, where just the sheer individuality of the actor who's responsible for whatever is going to happen is not quantifiable?
Depends where you sit. And so if you're a company and you're running a company, you know what is most important to you, and you draw the line there if it is about the things that are most important to you. Other risks tend to be the subject of academic specialization. And so where to draw the line on the pandemic risk? The pandemic risk was essentially a risk that a virus would mutate in a particular environmental context leading to a pandemic. That risk was well understood by experts who engaged on it. Wasn't necessarily something on the front page of the general public's mind until it became a world-changing event at the beginning of 2020. So I think there's really no right answer, and it really sort of depends where you sit, where you draw the line.
I'd like you to give us some guidance on Ukraine. How should we be thinking about the trajectory of that conflict? Vladimir Putin's intentions, or perhaps even his endgame, the domino effect of sanctions, European resolve, the possibility that the theater of war expands to include NATO members? How should we be thinking about that in terms of a conceptual framework?
Look, there are experts who will try to study the conflict really closely and understand the dynamic and the interplay of forces and all that. For the specialists, I think that's important to do. I'm not one of them, and I wouldn't pretend to do that. What I think is a more profitable thing to do is to understand the second and third order effects, what you called the domino effects. Is so trying to predict the outcomes on the battlefield and the negotiations, really, really hard to do. In government, it's important, but for most of us, we're not capable of doing much more than following the news, and we should be humble about our own analytic and predictive capabilities. Where I think you can get a little more traction is by playing through the downstream consequences of that through many different sectors. And so the primary result was a war in Ukraine. It is having multiple repercussions all over the world. It will affect food prices in the developing world as a result of a downstream consequence. And if you can, in a reasonable way, and recognizing your likelihood of being wrong on many things, trace through those consequences into the different sectors that you care about, that I think is a more profitable exercise than trying to be the world's best outside expert on something that you probably really don't understand that well.
If people want to understand better what you're talking about, the implications of that particular event, the invasion of Ukraine, but the geopolitical shifts that may follow or that perhaps lie behind it, what should they be reading?
A lot.
Who should they be watching or listening to?
I'm less confident on that one, on who they should be watching to, because a lot of information is who you choose to listen to impacts what you think and how you think about. But what should they be reading? My number one answer is breadth. I mean, to understand the interplay of these big global events is interdisciplinary and is a long process. And so Ray Dalio has a book out. He's talking about changing world order. He speaks about that. He's, I think, right in the sense in order to understand these particular events, you need to be strongly rooted in history and to see that many of these things have antecedents. They may be far back, but they are there. In the case of pandemic, we had some near misses, but the last one was 102 years ago before the current one. In the case of nuclear weapons, which I think we'll talk about, I think you can usefully go to the 50s and the strategic debates about tactical nuclear weapons that happened then to try to get a sense of what's happening today. So it's a tall order, and it's not something that lends itself to just go here, check this website, follow this blog or this Twitter feed. It's more like you've got to devote a lifetime to trying to understand the global order.
Going back to what you learned in the White House, what you lived through in 9/11, and what you observed and studied when you were earning your PhD, how would you describe what we're living through right now? Because people have put labels on it, right? Is it just a realignment of interests? Is it Cold War II, or is it the beginnings of World War III?
I would say we're in a phase where history is moving very quickly. And a large number of things which historically would play out over decades or centuries are happening in rapid succession. Both geopolitical events like the war, biological events like the pandemic, all the economic consequences of that come, but also multiple simultaneous scientific and technical revolutions, both on the computational science and on the biosciences, genetic medicine. I thought first I thought the end of the Cold War was going to be the major geopolitical event of my life. That's wrong. On 9/11, I thought it was going to be terrorism, and devoted a decade to working on terrorism. Then the financial crisis happened, then the pandemic happened, and now I think what we're seeing is a kind of accordion-like effect of multiple different major global events happening in relatively quickly. And so that would be the frame. I wouldn't give it a simple label of war or conflict, but I just recognize there are a large number of really seismic events happening simultaneously. And keep track of that is hard to do. And then to be very humble about your ability to predict it and understand it and label, I think is also essential.
And then just try to make investment decisions.
Not my job.
You frame it very well. You brought up the potential for nuclear escalation. Tell us a bit about that.
I'm certainly not saying it's particularly likely. But it's something we have to remember. And I'd say by and large, the general public probably forgot about nuclear weapons with the end of the Cold War. During the Cold War, if you were alive then, they were talked about a lot. It was a big deal. But with the end of the Cold War, they sort of went into the
hibernation.
Yeah, you didn't hear about them very much. And we heard about it with Saddam, but it turned out he didn't have, he wasn't that far along. We hear about it with Iran, but that's an incipient program. We hear about North Korea, that's an early stage program. Worrying, but early stage. But the idea that a mature state with a mature nuclear arsenal, which includes Russia and includes us, would be involved in a really intense conflict is a relatively recent, a new thing. Like we haven't lived with that in 20, 30 years. And so once they're in the conversation, you have to take them immensely seriously. They are a taboo. It's not been used since 1945. In general, we have a taboo against the use of weapons of mass destruction. And if they were to be used, and again, I'm not saying this is likely, but if they were to be used either accidentally or deliberately, it would be another huge threshold for the world order. That you just cannot ignore that possibility. Without being alarmist about it, you need to understand it. This is one thing I would say about the current administration. We, in New York or wherever we may be, don't think about these things very often. When you're in government and you're dealing with these things, you do think about it all the time. Not necessarily every day, like actively, but you know they're there. You were briefed on them. It is a discipline. There are specialties related to this. And that knowledge exercises a deterrent effect on everyone. So far, for 70 years, has worked to prevent the use of these terrible weapons. But everyone is worried, and a lot of people are worried, that that may be breached at some point. And as long as we have these, and we have thousands of them in all different varieties, we, the Russians, the Chinese, it's something that just must slow you down and must, you think carefully, not panicked, but to think about it carefully.
Richard, you were in the White House during the SARS outbreak, and you wrote about pandemic risk as a professor. Tell us what was going through, I should say, in your head in the early days of COVID, when all we knew about it was that some pneumonia-like virus had sprung up in Wuhan.
It was an extraordinary phase, and it would be written about by historians for a long time. My own experience was I was aware of what was happening in China, but it was very poorly understood. But then relatively quickly, in part because of the ability to genomically sequence the virus and the quick flow of information in the biomedical community, by somewhere between January and February, 2002, a synthesis began to emerge among infectious disease specialists that this virus inherently had a reproductive ability, an inherent transmissibility that was sufficient to make it not containable. Now, the consequences of that were not understood. We had no idea what the lethality of it had been. But I'd say there was a tipping point. I tie it to sort of early February 2022, when I saw that view. 2020, apologies. I saw that view take hold among the infectious disease specialists that I most respected and that I knew from 20 years ago.
And you took that seriously?
I personally took it very seriously. I wasn't alone, but it was, I knew from my study of history, and many others did, that such a thing had the potential to be a truly global shock, not just in the health event, but then the knock-on effects on global economies, shipping, international relations, societies, and the like.
I can validate that personally. The last time I saw Richard was at a sushi lunch at the very tail end of January or the beginning of February in 2020. And of course, knowing his background, I couldn't help but ask him what he thought about this viral outbreak in Wuhan. And it was beginning to spread. And he made it very clear to me at the time that this is something that he was very, very concerned about and thought that I should be and everybody else should be very concerned about. And the reality, of course, is that you're not the only person who took it seriously at Bridgewater. You and Greg Jensen had a webinar, didn't you, on it? And some people thought you were had lost the plot a little bit, didn't they?
I guess. We were maybe we were early. I don't know. I wasn't tracking it, but I forgot about that lunch when we talked about it. And it was a terrifying set of realizations. It was very vivid. You guys probably remember that. When was the moment when it turned and you knew this was something different? And I can pinpoint when it turned for me. It's different for other people. And then it developed in ways that like no one could predict, even though there were historical antecedents for it.
What did Bridgewater do well as an organization that helped it come to that realization quickly?
Well, it's for others to assess how well we did. I was in the middle of it. I mean, Bridgewater dedicates itself to trying to understand the world deeply and systematically. And that's sort of the objective, and our CIOs and others will explain their investment philosophy. But the essence of it is really deep fundamental understanding to the best you can achieve of major global developments, always caveated by humility and trying to be really aware of what we don't know. I mean, you probably heard me say in another of these contexts, my first principle of responding to a crisis is first reports are almost always wrong. And so when you have something happening, be it a terrorist attack or suspected terrorist attack, someone comes in and tells you X, like, do not overreact. Like, slow down, think hard about what it could be and study. And so that, even the way you say the question implies an overconfidence, I really would like to humble that and not suggest this sort of extreme confidence.
With that humility in mind, the pandemic is far from over, unfortunately. But if we look back on the past, now it's 2.25 years, thinking along the lines of what we're trying to do here, which is understand how to manage, conceive of and analyze risk, what lessons seem obvious to you
from the
pandemic experience?
Well, I mean, learn from history. Understand the interconnected of these things. And then the pandemic one is a wonderful illustration of what I said about the primary and secondary effects. The primary effect is a disease that's running wild through. In many ways, the second and third order effects, which are the bigger deal, like the response of governments, how they what they did and their reactions, and then how that cascades through the systems, the response to the human psychology. And so this is know about the primary effect. It's good to know about the disease phenomenon, but in some ways, it's all the responses and the responses to the responses that are the bigger thing, and that are where there's a lot of activity in a lot of different sectors, including the economy, resulting from that.
While we still have some time, I want to talk about cyber risks. Maybe even a decade ago, cyber risks seemed maybe perhaps a little bit exotic. They weren't that, well, they certainly weren't as ever present, and the attacks weren't so commonplace as they are today. And you could even think of, and I'm sure you do, think of the cyber realm as a theater of war. What do we all need to understand about the nature of cyber risk and the actors involved?
Well, it's a huge topic, but first let's put it in a historical context. Your premise is correct. 20 years ago on the transition team going into the White House, cybersecurity was not a top topic. And in fact, one of the experts suggested that the government should organize more around it in 2021, and that was rejected. And so it was really an esoteric topic. By the end of the Bush administration, I was out by then, but by 2008, it was emerging as, wow, this is a really big deal. And we went through a phase of being behind the eight ball in almost every level on understanding it, responding to it, preparing for it, how to deal with it, thinking about it. Governments, boards, companies, IT departments were sort of unprepared. It's now shifted significantly. Like any mature organization now has to take this immensely seriously and just understand this is a big deal. And it is a fundamental element of running your business is to understand that and to have very expert, skilled people and resources going against the problem systematically. Fortunately, the industry now has matured a lot. And so while the risk is still ever present and dynamic and complex, not easily predicted, there are systems, there are mature technologies and methodologies and things that exist that 10 years ago were not there.
To our knowledge, the United States, or for that matter, the Western world, hasn't yet experienced a major destabilizing cyber attack, the kind that, for example, would take down the electricity grid or internet service providers, as I say, to our knowledge. Is that surprising?
It's noteworthy, and to watch it. I try to avoid predicting these things, so that means I try to avoid being surprised when they do or do not happen. I think the important thing is to be aware of a range of possibilities and to be open that it could come up at any different way. So the thing that you described is, of course, a possibility. There are preparations underway for that. I'm not sure that they're adequate, and that could happen. Why, if that's happening behind the scenes, we don't know, possibly. If that's being deterred, if the capability was degraded in some way, who knows? We don't know. All the way through more pedestrian applications where it doesn't happen at all. So sorry for sort of avoiding the question, but I'm trying to be honest of what I do and don't know.
One of the more interesting aspects to the unfolding situation in Ukraine is the choices that the Biden administration and some of its allies, and I would cite the UK, has made in deciding to use information as a weapon. And in some respects, it's almost turning, I think of it as almost turning Putin-esque tactics back on himself. Talk to us about that, because it is so fascinating, and I know you've thought about it.
So think of the information space, the narrative about major events, as a domain of warfare. I mean, like air, land, sea, underwater, space, cyber, information is also a domain. And I actually agree with your premise that in some ways is one of the most interesting things to watch. Because while propaganda and censorship have been efforts long-standing to control the information plane in warfare, I actually think this conflict is showing significant innovation, particularly with the release of intelligence, sensitive, previously super secret compartmented intelligence that the US government and others have about what Russia could do, what they're thinking about, what they're capable of, in advance of it actually happening. And unlike, say, the Iraq War, where there was an unsuccessful attempt to shape that with what turned out to be somewhat incorrect information about Iraqi WMD, in this case, it looks like they're mostly accurate forecasts. And I think in some ways, this conflict is almost writing a new playbook, a new page in the book of statecraft, of how you can proactively shape the information environment through the selective release of things that you learn through secret means. And I don't have inside information on that. I'm watching that from the outside, the Gulf view, but I urge you to watch it closely because I think it's fascinating. And frankly, Eric, events like this are part of that information plane. Like this, going on the terminal and going on television and on radio, that is an element of interstate conflict, and this is just another place where it's playing out.
Well, Richard, I knew this conversation about risks you can't afford to ignore would be terrific. And ladies and gentlemen, I hope you weren't disappointed. Please join me in thanking Richard Falkenrath. Thank you. I would like also to thank all of our speakers this morning. Folks, we're serving lunch now. Please enjoy it, and we'll see you back here promptly at 1:30 when we're going to kick it off with a special live taping of the Bloomberg Wealth TV show with David Rubenstein and Avenue Capital Group's Mark Lazary.